9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
That's right. We hope you enjoyed your long weekend and are well rested because we've got a busy day ahead of us. Futures, they're ticking lower after stocks saw their first losing week in over a month. This coming on the heels of hotter than expected inflation data causing investors to reconsider the timing of Fed rate cuts, potentially putting the soft landing at risk. And all of this is ahead of Nvidia earnings later this week. The results will likely put the recent AI-fueled rally to the test.
One of the big drivers of this morning, well, it's all about earnings. Quarterly results from two Dow components. We heard from Walmart and Home Depot, both giving investors an inside look at the health of the consumer. So let's get right to it. The three things that you need to know, your roadmap for the trading day. We've got Yahoo Finance's Josh Schaefer, Jared Blickery, and Madison Mills here with more.
Hey, Shauna, shares of Walmart climbing higher in pre-market trading after reporting a stronger than expected holiday quarter. The big box retailer rising its dividend by 9%, its largest boost in more than a decade. All of this as Walmart continues to invest. The company also saying it plans to buy smart TV maker Vizio for $2.3 billion.
And a gloomy outlook for Home Depot. The home improvement retailer's 2024 sales growth forecast missing analyst expectations as consumers that continue to pull back on those big ticket purchases. The company also saying higher interest rates take a toll.
And M&A mania because we have a potential $35 billion deal with Capital One potentially merging with Discover Financial Services. Now, this merger would, of course, be pending regulatory approval. If it goes through, though, it would happen either later 2024 or early 2025.
Walmart shares climbing higher in the pre-market with revenue jumping 6% from a year ago, helped by a 23% boost in e-commerce sales. The retail giant also announcing that it has officially agreed to acquire Vizio in a $2.3 billion deal. Oliver Chen, TD Cowen senior research analyst, joins us now with more. Oliver, great to see you here with us this morning. First and foremost, you read through this report. Ultimately, investors pleased with what came through, and ultimately now a larger kind of consideration around what this means for the consumer. What's your read through on the consumer from this Walmart earnings report?
Yeah, Brad, we're excited. Walmart is our top idea. It's great being here with you and Shauna this morning. The consumer is facing cross currents, really. The consumer still has spending power, but is looking for extreme value. Walmart is offering that. At the same time, consumers are looking for convenience and valuing time. That's a big factor as well in terms of Walmart offering many convenient factors such as drone, pickup and delivery, curbside pickup, and the marketplace model. All these things are really working together in nice harmony as well.
Oliver, one of the big headlines out of this report here this morning was the fact that Walmart's buying Vizio for over $2 billion. I'm curious from your perspective, obviously the analyst perspective here, does this make sense? And if so, why?
Yeah, we're excited about this. We call it the new Nexus. And as we think about Walmart, there's a marketplace opportunity in terms of third-party selling. There's also a big digital advertising opportunity. And Vizio Connect will help enable this, given that they have an operating system that already has about 18 million members on the SmartCast system. So this will help accelerate digital advertising, which is a very, very high margin business, 70% plus margins as we model it. And it's growing at 30%. So digital advertising is the future of Walmart. And we see this as a tech company as well. That's why it is one of our big ideas. The other part of this, Shauna, is artificial intelligence. So Walmart is already using generative AI and computer vision for more accurate inventory management, as well as the customer experience in terms of generative AI, helping apps and helping employees locate goods in store. This is really happening. In addition, they mentioned drones on the call. They've already delivered 20,000 packages through drones. That is 15-minute delivery speeds and higher household incomes, as well as Walmart Plus So a whole ecosystem is working as well as a flywheel to help drive sales and margins.
What type of pricing do you think that they need to put into the market with this Vizio service, and in order to strike the right tone among the consumers that they've already seen on the brick and mortar side, on the e-commerce side, and now on that digital streaming side?
Yeah, we've been excited about Walmart Plus, and that's seen a lot of momentum. Furthermore, the higher household income story has been a big part of the story too, in terms of that cohort really appreciating delivery marketplace as well as a lot of the general merchandise. We will see. I think Walmart will offer exceptional value and use advertising as a methodology to both generate profits and help subsidize some of the media as well.
Oliver, going back to what you were saying earlier, just about the consumer right now and what these results tell us about the state of the consumer, we are starting to see, although inflation obviously remains very sticky, prices of certain items are starting to come down just a bit. If we see more of this deflationary type of environment take hold, what's the impact on Walmart, and what do you think that ultimately does to demand here in the long run?
Yeah, Shauna, it's something we're looking at quantitatively in terms of the top line. What's been happening is disinflation or deflation. That definitely takes away from revenues. However, the consumers in this tug of war between essentials and needs versus wants. Therefore, the positive impact of disinflation is the consumer may have extra dollars freed up for general merchandise. General merchandise trends have been bumpy and negative. Home, big ticket, seasonal, apparel, it has not been great given the inflation that we've been seeing. So we're looking forward to disinflation, prices moderating, as this will free up dollars for consumer discretionary, which are much higher margin generally. So it is this tug of war. On the one hand, we have a tight labor market, low unemployment at 3.7%, and wage growth at 5%, but inflation is still running around 3%. And consumers are using credit cards more and have less liquidity. These are all factors to watch. Consumers are definitely looking for value. That is partly evidenced by private label and the momentum we see in private label as well, and the deep value that private label offers. There's a big gap between private label and national brands as well.
All that considered, Oliver, you mentioned Walmart as a technology company. How does that trickle through to the multiple as well from your perspective? And I mean, right now we're sitting at a PE ratio of about 28, 29.
Yeah, Brad, we like it because Walmart's offense and defense. On the one hand, it's very defensive in terms of being the U.S.'s largest grocer with tons of value. On the other hand, it's offensive in terms of this whole flywheel, marketplace, AI, digital advertising. It should only get more exciting in terms of this whole ecosystem coming together and driving convenience and competitiveness. Over the long term, we've always loved bricks and clicks. So the integration of physical and digital is the secret formula for really winning over the long term and also managing customer acquisition cost. Being physical is very powerful. 90% of America is within 10 miles of a Walmart. And as we think about Walmart more broadly, healthcare, financial services, pharmacy, these are all aspects that will work together in this whole flywheel.
Oliver Chen, always great to get your insight. Again, Walmart shares moving higher on the heels of this report. Oliver, thanks so much for breaking that down for us.
Great being with you both. Thank you. Good morning.
And keep right here on Yahoo Finance's The Morning Brief. Stay tuned for our interview with Walmart CFO John David Rainey. He will join us later on this hour. You won't want to miss that. Well, the other Dow component reporting earnings results this morning, it's Home Depot. Shares trading here to the downside, off just about 2.5%. Now, this is the fifth quarter in a row that Home Depot posted revenue declines. The home improvement company's comp sales falling 3.5% from a year ago, also forecasting a 1% decline in fiscal 2024. You're seeing some of that concern being reflected in the share price here this morning, off just about 2.5%. But Brad, my two takeaways from this report was the reading on the consumer, very similar to what we saw or what we are seeing from some of those other larger retailers. The fact that the consumer is being a bit cautious at this time, thinking twice, being a little bit more selective about their spending. That was reflected in the average ticket sales here, declining more than expected here for Home Depot. And then the second, this also highlights some of the challenges for the housing sector right now. We talk about the fact that higher rates, we've seen a drop in demand for remodeling, for home construction, and we're seeing that reflected in these results from Home Depot today.
Yeah, and it also reflects a more tepid Home Depot, I would say, as well. Of course, in our channel chats going into this show, we were looking at the inventory levels here going into that important selling season for the spring here, when everybody's ramping up the lawn and getting all of those projects lined up, perhaps to get outdoors and work on a few more DIY projects. All those things considered, the inventories are well off of where they were this time last year, perhaps spells out a more conservative Home Depot. You also saw more of the fiscal sales decreases, sales for fiscal 2023. You saw that decrease by about 3%, and then comp sales, they were also down by about 3.2%. In the U.S., 3.5%. So all these things considered, it's a larger question of what that inventory pickup will actually look like from the consumer level. If you got a lawnmower, you probably don't need another one. That eToro, or not eToro, that Toro or that John Deere is probably working just fine, and ultimately, you don't need 17 grills. You just need 2, maybe at some places.
Yeah, well, right, and that kind of points to the fact that, right, how long is this type of tepid growth environment or more challenging type of environment likely to stick around here when it comes to Home Depot, when it comes to so many of these names that are very reliant on consumer spending? And yes, this report highlights a number of challenges facing the company, facing the industry, but Wedbush was one of the names that actually came out ahead of these results last month, upgrading the stock to outperform on that expectation that a rebound in the industry, in the environment right now, they see as likely here going forward. They are optimistic just about solid wage growth, homeowner spending power from continued home price appreciation. So they do expect that the consumer will return, will start spending once again on remodeling homes. But it's going to be a challenging couple of quarters here for Home Depot.
You mentioned an interesting stat when we were sitting at our desks out this morning here, and from Torsten Slok, about the number of people that actually aren't moving right now, or at least the small percentage that are. And that all considered, I mean, it really comes back to how that impacts Home Depot, where some of the consumers, even if they are moving less, where they're going to look across kind of the home and say, okay, yeah, we could fix that up or get ready to put it on the market. It doesn't seem like that is really kind of going to be a dam that breaks, at least as of right now, unless we see a dramatic cut in interest rates.
Yeah, exactly. I think so many people, what is it, 80% of homeowners, 70 to 80% of homeowners are locked into rates of 4% or below, 5% or below. I believe so. When you take a look at the fact that you have mortgage rates right around 7%, if you're locked into a much lower mortgage rate, your monthly payments are a fraction of what they would be. If you are moving, you're not going to move. So you would likely ultimately spend on remodeling at some point if you're going to stay in that house. But as you can tell from Home Depot's numbers, at least that spend isn't happening right now with rates high. All right, well, switching gears here and taking a look at 2 trending tickers on Yahoo Finance shares. Discover Financial jumping this morning, looking at gains of just about 12%. This comes after Capital One announced that it is going to buy the credit card lender in a deal valued at $35 billion. Now, this deal pulls together 2 of the top 6 credit card companies by purchase volume. So putting this in perspective for everyone, the merger could have big implications for competitors like Visa, MasterCard, and American Express. And this is one of the angles that our executive editor Brian Sazi is digging into on our homepage here this morning in our blog, talking about what this would mean here for the broader financial industry, for the broader credit card industry. But again, this creates the largest credit card company by loan volume. And we know Capital One being backed by Warren Buffett here, this really enables, ultimately, you can make the argument, better compete with some of those Wall Street behemoths that are out there. And we're seeing that reflect at least some of that optimism, obviously, in Discover shares today, although Capital One under a bit of pressure. Not exactly a huge surprise.
Yeah, some of the financials that they're talking about on this deal, $2.7 billion in pre-tax synergies, also return on invested capital of about 16% in 2027 is what they're expecting, an internal rate of return of about 20% here. There was a conference call this morning. We'll see what more continues to come out of the discussions as these companies are looking to then solidify this moving forward as they hope to get it past the regulatory sniff checks. But as of right now, as you were mentioning, bringing together two companies, huge track records of some of the, as they would say, resilient financial results. It's a larger question for me, I think, and even as we were talking about it during our meeting this morning, what is the core customer that they're going after? This is not the same type of customer that Discover has on their balance sheets that an American Express does. And so as you think about that, it is a larger question of what some of the net loss or net interest expenses that they have to think about with that customer are. And then ultimately here, the shareholders at the end of the day too, they're saying that Capital One shareholders are going to have about 60% and Discover shareholders about 40% of this combined company once everything is fully consummated in the deal as well here.
Yeah, certainly. I think the vibe on the street here early this morning is it makes a heck of a lot of sense here in the longer term, especially when you're going up against some of those larger players. RBC, one of the analysts here on the street, echoing that sentiment this morning, saying that they believe the combination of Capital One and Discover should be strategically compelling from a competitive perspective. But once again, you're seeing some of that pressure on shares of Capital One this morning. A lot of that probably tied to what you're looking at on your screen there in the lower third, the $35 billion price tag that they are paying here for Discover. So again, we will see how it trades for today, but the early vibe on the street is strong here for this merger. All right, we'll keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
Let's take a look at some trending tickers here. Shares of Barclays, they're trading higher pre-market after announcing more than $12.5 billion in capital returns over the next 3 years, as well as cost-cutting measures and restructuring plans here. So no doubt there's going to be some headcount impact with regard to the broader kind of banking and financial services sector. We've had a few of those come forward over the start of this year here, so that also hitting Barclays here. You look across some of the income lines here, as the company had reported as well. Group income, that was up by about 3% year over year. They talked about some of the structural hedge income uplift, if that is something that really gets you jazzed when you look at Barclays here. But I think at the end of the day, as you think about where Barclays is going to restructure, where they've got to realign the business, it'll be a larger question of how much they lean more into that investing business as at a time where the thesis is just, hey, just throw everything in the wall that you can at AI versus some of the other areas that they've leaned into in the past, and notably what that fixed income business looks like.
Yeah, Brad, I think Citi summed it up pretty well in their earnings reaction to this report, saying that Barclays has really turned into an even more of a show me story following these results. They went on to talk about the fact that the bank is offering a lot of detail to support conviction in new targets that have been laid out. And RBC echoing a similar sentiment here, but also making the argument that the current valuation right now is a good entry point, with the valuation gap having widened here despite some of the outperformance that we've seen in Barclays. So I think when you take a look at what this ultimately means for the bank here going forward, this following in similar footsteps, maybe you can make the comparison here to Citi, just in terms of a complete overhaul or restructuring of their divisions, trying to adjust the bank here for the future. In Barclays' case, a restructuring here into 5 divisions here. They're saying that makes a heck of a lot of sense here in the longer term. They have their UK retail bank, the UK corporate bank, went on with private bank and the wealth management arm, and then their investment banking division and the US consumer bank. And going back to some of the deal-making activity or lack thereof that we've seen over the last several quarters here, we saw that reflected in these results here from Barclays. Our corporate investment banking total revenue falling just about 7%. So they are optimistic about what that deal flow activity is going to look like over the course of 2024. But I think the question that so many analysts, so many shareholders, investors are asking right now is how quickly some of that activity is going to return. Yeah,
it's a reinvention story when you've got a slide in the earnings deck that's called we know we need to do even better here. Yeah. And that's exactly what they had here, looking at operational and financial. Financially, they want to drive towards some of those higher returns within those divisions that we were breaking down a moment ago. But stronger cost controls, that was the second thing that this company mentioned within those financials. And so ultimately, we'll see what type of enhanced financial reporting they're able to provide going forward. That was one of the other items here. But at least operationally right now, that reduction in organizational complexity is something that's going to catch the eyes of any of the investors that are looking across this name today.
All right, well, let's take a look at another trending ticker here this morning. It's a name that we've talked about a lot over the past week, and that is, or past several weeks, I should say, that is JetBlue, ticking higher in pre-market trading after the stock got an upgrade to buy from hold at Deutsche Bank, more than doubling their price target. They're raising it here to $9 a share. Now, this upgrade, of course, coming on some of the developments that we saw last week with Carl Icahn, the activist investor there, unveiling that 10% stake in the airline, also winning those 2 board seats. Icahn making the argument that he still thinks that shares are very undervalued given the underperformance that we've seen of the stock over the last year or so, past few years here. So Deutsche Bank jumping on board with a more optimistic outlook, saying that they expect a more moderate domestic available seat mile growth here for 2024, and that's going to have positive implications for their domestic unit here down the line.
Yeah, absolutely. I mean, you think back to what conversations we've had with even our good friend Steve Trent over at Citi, who's been able to chime in on this deal. And really, just the probability of the appeal here is largely in question. And I think that spells out more kind of doom and gloom for Spirit Airlines, but for JetBlue as well here, a company that's already had the NEA, that Northeastern Alliance, essentially broken up that they had with American Airlines. So that's completely jettisoned them into a different type of realm where they need to succeed on their own. And so the U.S. judge that's already looked at this deal, blocked the merger. Now for JetBlue, it's a larger question of as a ultra-low-cost carrier in an environment where consumers are continuously gravitating towards some of the more premium tiers and premium options and not looking to be nickel and dimed. Where does JetBlue kind of make its play or make their value proposition to that customer, especially as you have this rebound in corporate travel taking place right now, too?
Certainly. All right. Well, we've got to get to break here because we are in the final minutes ahead of the opening bell on Wall Street. Once again, you're still looking at pressure across the board with the major averages looking to open in the red. This all comes on the heels of the latest econ data that we got out last week and squaring that with Nvidia, the big earnings report that we will be getting tomorrow. We've got the opening bell for you when we come back. Time for today's stock to watch, and that is GlobalFoundries. Shares on the rise here, up about 5% after receiving $1.5 billion grant from the Biden administration. Massa Mills is on the floor of the New York Stock Exchange with the latest on that move. Maddie.
Yeah, Shauna, this is the name that is the latest beneficiary of the CHIPS Act from the Biden administration, which has over $50 billion to dole out to companies that are going to be able to produce chips stateside. And that is exactly why GFS, that's the ticker symbol associated with GlobalFoundries, was picked for this funding, again, to the tune of $1.5 billion. That is why we're seeing a lot of upward movement in this name this morning. Now, having said that, we're not only focused focusing on GlobalFoundries, which, by the way, again, they're known for being the biggest stateside foundry in terms of chips production. That is why they were picked for this funding. But we're also looking at shares of Intel this morning, up off of news that Intel could be the next company selected by the Biden administration for funding from the CHIPS Act. And that is according to reporting from Bloomberg News. So the big question here is, which companies can investors be looking at moving forward to suss out whether or not they will receive funding from the Biden administration? Because we tend to see that as the CHIPS Act goes, so does the market. And that is exactly what we're seeing with GlobalFoundries today, up over 5% off of this funding news.
All right, Maddie, thanks so much. We're going to check back in closer to the opening bell. Well, we've got just about 45 seconds until that opening bell on Wall Street. A lot in play, of course, this week, as well as some of the earnings that have already dropped here this morning. Walmart, Home Depot, we ran through some of those for you, but really a lot of focus on Nvidia as well going into this week. This is the company that has now overtaken Tesla as one of the most traded names, the most traded name on the street right now. So take a look at Nvidia's shares. Oh yeah, read them and weep. Well, they're down by about 1% at this point in time. We'll see ultimately what the company reports later on this week and what that means for this larger AI fruition that we've seen, or this AI trade that has really had a lot of wind in its sails.
Yeah, Brad, I think that's the key question here for the broader market, at least just in terms of ultimately what these results are going to mean for the movement that we could see later on this week and, of course, carry over into the following weeks, whether or not it starts to poke some holes into that AI-fueled rally that we have seen really carrying the broader, the major averages here over the last several months.
That's right. That's the opening bell on Wall Street. Take a look at the NYSE.
A lot of excitement for this Tuesday morning.
Oh my goodness, you got the MLS ringing the opening bell at the Nasdaq. How could you not be excited? Big soccer, big football energy. Okay, funfetti in the air. You've also got ticker symbol OMC, PhD, intelligence connected. Just reading the screen at this point. Anyway, take a look at the opening bell and also the major averages here. We've got team coverage, but first and foremost, feast your eyes on this. We've got some declines out the gate right now for the Dow, the S&P 500, and the Nasdaq, fractional declines. We've got team coverage here. Yahoo Finance's Maddie Mills on the floor of the New York Stock Exchange, and Jared Blickery on standby at the Interactive. We might be seeing some broadening of this market. Maddie, what are you hearing around the exchange?
Well, let's hope, right, Brad? Because the reason why you want to see broadening is exactly like when you see a day like today, because we're seeing a sea of red across the Magnificent Seven, not a single name in the green, and that is why you're going to be seeing the major indices down so far today. When I look at the S&P, the Nasdaq, the Dow Jones, all in the red, and that is what's going to happen when you have a market rally that is driven by just 7 names. Now, having said that, luckily, we have seen some evidence of broadening so far this year. If you take a look at some of the returns since October lows, we're looking at some better earnings prints from some names outside of that Magnificent Seven, particularly in the financial space. So that's going to be benefiting the broader market rally. Not so much today, though. I'm looking at that Russell. That is down this morning. All eyes, though, looking at Nvidia heading into tomorrow's earnings print, you guys.
All right, abbreviated trading session. Somebody wake up these markets here. Maddie, thanks so much. We appreciate it. Also here, let's check in with Jared Blickery. He's at the home base here at the Interactive. Jared, what are you watching?
That's right. A little bit of a defensive posture to begin the trading week here. Small caps down 1.34%. See if we have time to chart them, but I've been seeing a pretty bullish pattern set up in the small caps. First, we want to check out the sector action today. Not a lot to speak of in terms of green, and what little we do have is defensive in nature. So we got consumer staples up 0.8%, and healthcare just barely holding on to some green there. In the red, we have real estate, consumer discretionary, and also financials. And let's just take a quick peek at the Nasdaq, and we can see a mixed board even for the mega caps there. Nvidia down 1.5%, so not seeing a record high just yet, but it is pretty early in the goings here. And before I get too far in heat map land, I want to look at some longer term charts here with respect to some other market dynamics. We got the VIX here, which you can see on a 3-month basis is somewhat elevated, but if you take a look at the 3-year, we do see that that it's in the lower end of the range, so not too much going on there. Also want to quickly track the U.S. dollar index. That has now retraced to the downside all of those CPI gains, so that is a little bit less of a, I guess, not so much defensive, but that is a headwind that we're taking away from the market. Headwind is what I'm looking for.
All right, Jared, thanks so much for breaking that down. Of course, we're going to keep our eyes on the early developments here in market trading. But let's start with one of the big winners here at the open, and that is Walmart. Walmart's strong holiday showing pushing its global e-commerce sales up 23% from a year ago to over $100 billion in 2023. The retail giant also doubling down on advertising, buying Vizio here for $2.3 billion. Let's talk all about that and more with John David Rainey. He's Walmart's CFO, joining us now alongside Yahoo Finance's executive editor, Brian Sozzi. John David, it's great to have you here. Thanks so much for joining us this morning. A very strong quarter, to say the least, from Walmart. You've got your stock hitting a record high today. Talk to us just about what you're seeing consumer spending wise and some of the trends that you're noticing here in the early months of 2024.
Well, good morning. It's good to be on the show. We're really pleased to have announced a really strong fourth quarter earlier this morning. We grew our top line almost 6%, but I think importantly, grew operating income 13%, which is really strong and shows the core earnings power of our new model. Through the holiday season, we saw that customers certainly are coming to Walmart, shopping us more. We gained share, and we were pleased with what we saw overall. In fact, our two largest sales days ever were in the week before Christmas. We continue to see some strength through January, and overall, when we look at the quarter, we've gained share in almost every category. So customers are shopping Walmart, and we're getting better at how we serve them.
John David, Brian here, always nice to see you. Let me just swipe the earnings results to the side for a second. I want to get into this Vizio deal. Now, you are no stranger to making big deals. You did a lot of this stuff when you were over at PayPal. Is the real magic or the real value in this $2.3 billion deal in the access to the customer data that Walmart gets?
Well, Brian, it's good to speak with you. Let me start with advertising broadly. Advertising grew 33% for us the most recent quarter. This is a fast-growing, high-margin part of our business. And what this deal with Vizio does, it's very complementary to what we were doing organically. It allows us to use their operating system to connect and serve with customers in different ways, to provide a new channel to actually provide better service to our customers and connect with them through data.
John David, let me just stay on this one. Do you expect the regulatory vigilance to be even just tougher for a deal like this, given you are getting so much access to data?
Well, we operate in a complex and highly regulated environment in a lot of what we do. We think this deal makes eminent sense, and it ultimately allows us to better serve our customers, which we're looking forward to.
John David, you think about the mindset of the consumer and the read-through that you're getting to the consumer from this earnings period and what that spells out about how they are also kind of continuing to engage with Walmart versus some of your competitors. What would that read-through be?
Well, it's been pretty consistent, Brad. We've seen that customers are continuing to be choiceful. They're using discretion with some of these larger ticket items. And when we look at the composition of the basket of when they're shopping with us, they're putting fewer items in that basket, but they're actually shopping with us more frequently. And we see that we're gaining share relative to others, which I think illustrates that this omni-channel retail model that we have that has a strong physical footprint, but also a growing and thriving e-commerce arm to it is really resonating with customers.
John David, when you take a look at the fact that we are starting to see and have started to see inflationary pressures begin to abate just a bit, if we do see more of this deflationary trend take hold, about what exactly this means for Walmart and ultimately demand that you expect to see from the consumer in the longer run?
Well, prices have come down. We've seen certain categories like general merchandise, as an example, that is deflationary right now. Prices are lower year over year. There are other categories, food and consumables, where we still see low single-digit inflation. Fundamentally, though, we want lower prices for our customers, and we're trying to do that, working with our suppliers, even focusing on our own private brand. Prices are still high relative to where they were a couple years ago, but it's interesting because it's difficult to generalize right now about where some of these price pressures are. If you take a category like pet as an example, pet food is actually much higher year over year, but pet supplies is actually much lower. So it's a bit of a mixed bag as we look out over the coming quarters, but pricing prices are still high for customers.
This has been a really impactful few weeks for Walmart in the lead up to this earnings. Of course, store managers getting higher starting pay. You have the stock options up to $20,000 for store managers. That is big stuff. Zooming out, do you think Walmart is just going through a cultural reset?
You might call it that, Brian. It's interesting, the characterization of it. Look, I think fundamentally for us, we want to continue to invest in our associates. Fortunately for us, we have the margin profile as a company right now where we can still do that, invest in our associates, but also see our operating income grow faster over time. I think a consistent theme through my 2.5 decades of work is that when we get the operators of our business, the front line, to act like owners, that's a very good thing for shareholders as well. So we're very happy to allow our store managers to participate through share ownership with a stock grant.
Just want to go back to that Vizio deal, John David, quickly. So I was thinking back to when Walmart signed his deal with Paramount. So if you're a Walmart Plus member, you gain access to Paramount. It really is a pretty sweet deal. Does Walmart have any more ambitions to get into the media space? Because from the outside looking in, I see what Walmart's doing, I see what Amazon's doing, I see what's Google doing, and there's a major recasting going on in the media landscape led by some very large companies.
Yeah, well, that's arguably a red sea of competition, and I'm not sure that that's really what we need to be focused on. I think we can provide better value to our customers by focusing on some of the basics that they expect from us. We still need to improve with our delivery, with our e-commerce capabilities, and we know that we've got a plan around that, and we're excited about the improvements we've made over the last couple of years, but we want to focus on the basics while providing amenities to our customers that they'll pay for and that they value over time. The Walmart Plus subscription right now is of great value, and we see a lot of the newer customers that are coming to us, particularly through this higher income demographic, are signing up through this channel. So it's an exciting part of our business.
John David, just lastly while we have you here, I'm a little upset that I go on the website. You're sold out of some of the classic Reebok shoes, and we're coming off of All-Star Weekend for the NBA. There's been a lot of fanfare around what Reebok, what Shaq, what they've been able to do in terms of making sure that some of that apparel, that footwear, is more affordable for people coming into Walmart here. But you think about some of the homegrown brands that you've been extremely successful with as well. You know, where do you prioritize making sure that you're getting in some of these household name brands versus where you're actually spending more to make sure that you've got specific homegrown brands in categories that are doing successful?
It's a balance. We want to always provide national brands for our customers because that's what they want to buy. But at the same point in time, as we talk about higher prices, giving them an option to use our private brand, our owned brands, is really important to them. These private brands can be 10 to 30% less expensive than national brands. And as consumers are pinching, as their dollar is going less far right now with higher inflation, that's important to them. And private brands is a big part of our business. In Walmart US, it represents over 20% of our business. For Sam's, it's over 30%. So this is a nice complement to the national brand assortment that we offer for our customers.
All right, I'm going to keep
And we'll
refreshing.
try to make sure that we have those Reeboks for you.
Hey, look, I'm just sitting here hitting refresh. Refresh is my favorite button right now. We'll see if they come back at least within the next few minutes. Walmart CFO John David Rainey, thanks so much for taking the time here with us today. We always appreciate it. And Yahoo Finance's own Brian Sozzi.
Good talking to you.
Likewise. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Well, the major average is under pressure to start the week. You're looking at losses for the Nasdaq of about 1%. Now, this comes as investors digest earnings results from Walmart and Home Depot and also look ahead to Nvidia's earnings print tomorrow. It is looked at, most largely viewed here, as a huge test for that recent AI-fueled rally. Let's talk about it with Michael Antonelli. He's Baird's Managing Director and Market Strategist. Michael, it's good to see you here. So just put this in perspective for us. How much is riding on Nvidia's print in terms of what that means for the broader market performance?
It's great to be on with you guys. I think it's certainly a major factor. I mean, everybody will be speaking about it. Everybody will be watching Yahoo Finance when it comes out. I think it will definitely have an impact on the short-term direction of the market. Is something like Nvidia starting to become more important than, say, an Apple or an Amazon? I don't think so just yet. We do talk about it a lot. It's definitely interesting to look at its chart and see what it's done. Will it have a bigger impact than those names? I don't think so. But I do think that in terms of what we want to see from them, trying to hold up these lofty expectations is going to be a challenge. I mean, there's definitely a lot into the stock.
Yeah, I mean, at the end of the day, even as they're going to be watching Yahoo Finance when those earnings do drop, they're going to have to replay this video a lot of times between now and then. We'll get those numbers up. But anyway, Michael, as we think about where the investors are going to continue to lean into the continued growth trajectory for Nvidia, I mean, they're going to be facing some tough comps after a while here. What do you expect that to net out in terms of some of the investor sentiment as well?
I just think, let's just talk broadly about investor sentiment around AI. We saw last week, we saw a pretty hot inflation print, and we all looked at the market and said, wow, maybe we need to rethink rate cuts, what's going on with inflation. When we talk about AI versus inflation, there's a reason why the stock market's not really all that dominated by CPI, PPI inflation prints. It's because of AI. AI has essentially sucked all the oxygen out of the room. It just that theme, the kind of catalyst of AI is just absolutely on everybody's mind. So whether it's Nvidia or Arista, there's a whole bunch of companies in there, whether it's Facebook and Amazon and Google, everybody's looking towards this AI theme to try to find the little nuggets of information. So yes, Nvidia is important, but so are these other companies that are also a component of this big AI theme. And that's what markets do every now and then. They get obsessed over something, and we're ignoring inflation just because of the AI thing.
I was going to say, Michael, a number of investors are obsessed with the AI story, and a number of investors, obviously for good reason, are obsessed with the inflation story and what the Fed is going to do, the likely timing potentially here of these rate cuts. The results, or the econ data that we got out last week, the two readings on inflation, does that at all reset or alter the Fed's thinking just about the progress that's been made so far?
Certainly, I think it makes them rethink the whole notion of whether the cuts are about inflation or whether the cuts are about, economic growth. And when you look at the inflation numbers, it's understandable why the market continues to wring its hands and about rate cuts being too early. The meme where the guy's standing around the pool and he's just standing around waiting for something. That's us standing around waiting for shelter inflation to fall. It just is this one huge thing inside of inflation that refuses to come down as quickly as most of us had hoped it would, and that's holding up the goal of a 2% inflation rate. So we are still kind of waiting for that, but I do think the market has shrugged off worries about inflation. Again, all we want to do is remove the tails, right? When you remove the tails, the inflation surging, inflation plummeting, then the market can get its arms around what's happening.
Where is the hottest area then to be at in the market with that at play?
Hey, you guys just had a great interview with Walmart. Consumer discretionary stocks, consumer staple stocks, consumer stocks are doing really well. I thought that was very, very fascinating what they said. Look at their chart. Look at what they talked about, a stronger consumer in their earnings release. Industrials also continue to lead the way. Does that sound like a market that's being led by only 7 names? Walmart's up 14% year to date. It's a massive company. All right, that's not one of the Magnificent Seven, is it? So consumer discretionary, consumer staples, financials, industrials, they all look really interesting to me. I don't think you necessarily have to just worry about these big tech names. There's a lot of great catalysts. There's a lot of good companies out there right now.
All right. Thank you so much for joining us. Michael Antonelli, Baird Managing Director and Market Strategist. Always a pleasure to get some of your time and insights.
You're right.
Thanks. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Investors are eagerly awaiting an AI golden child, Nvidia's Q4 earnings report on Wednesday. The stock is up more than 200% over the last year, and the frenzy around AI has been largely responsible for the recent market gains. As of Thursday last week, Nvidia accounts for 30% of the S&P 500's gains this year. For more on this, we turn to Ruben Roy, who's the Stifel Applied Technology Analyst. Ruben, great to have you here. We've been trying to tee up Nvidia throughout the show this morning here, and one of the huge things that jumps out is just how long this rally, this momentum that's been at play for Nvidia can continue, and what the company has to signal within this report. What would you be looking for?
It's a great teeing up is exactly right. So this is it's going to be a very, very closely watched, results and outlook, as I think your previous guest just noted. And we're looking for more of the same, really. If you look back at the last several quarters, NVIDIA's had nice beats and raises from, sort of their outlook perspective to what they actually printed in terms of results for the given quarter and, in terms of the outlook relative to consensus. And we're expecting more of the same, like I said. We think that supply of GPUs has improved modestly, meaning that there's still, sort of this disconnect between demand and supply, demand being greater than supply. So we do think that NVIDIA is able to fulfill, some of the demand out there, but there's still a lot of demand behind that, right? And so, we think it's going to be a positive commentary with potentially a little bit left in the pocket here ahead of NVIDIA's very important technology conference, which is coming up mid-March, GTC. So at that conference, we're expecting new roadmap, technology, information, et cetera. So a lot to go through when the numbers and the commentary comes out from the company, but we're looking for positive results and guidance.
Ruben, I guess how much of that is already reflected in the run-up that we've seen, not only over the last 18 months, but even since the start of the year? You're looking at share gains of just over 40%. Does that, do you think, set up NVIDIA, at least in the short term, the very near term, for a potential pullback on these results?
Could be. We're looking past sort of the near term. Like you said, already this year, it's out. The stock's been outperforming the rest of our group by quite a bit. Can it be volatile over the next several months? Sure. There's been a lot of discussion about how far the stock's gone, valuation, et cetera. But if you take a little bit of a longer term perspective, this year, if we look at the big cloud service providers, the Amazons, Googles, Metas, et cetera, of the world, Microsoft, the CapEx budgets are going up in excess of 25%, for the full year versus last year. And we think a lot of that incremental dollar spend is going to go into AI infrastructure. And if you look at the competitive dynamics out there, AMD, which we like as well, as a distant number two player in this GPU accelerate for AI, has taken up their outlook for AI chips by 75% in 90 days, really, from late last year to early this year. But they're still talking about shipping maybe $3.5 billion worth of GPUs into AI infrastructure this year. And so when we look at that incremental spend, which is very, very significant, most of that spend in our view is going back into NVIDIA. And this is to build out, continue to build out these large language models. And so when we take that into perspective, yes, there could be some volatility near term, but I think it'll smooth out over the next 12 to 18 months with NVIDIA continuing to remain at the forefront of what's going on with AI infrastructure investment.
If NVIDIA comes out and misses on this, what is potentially a Goldilocks report, is that the rug pull on the broader markets, especially given how AI has fueled this rally?
That would be tough, right? Because there's obviously a lot of expectations here. One of the things that we've been talking about with our tech team here at Stifel has been sort of this concept of broadening of AI infrastructure spend. And we are starting to see that with things like AI networking, companies that are exposed to interconnecting these GPU clusters and then out into the rest of the data center and rest of the world. And, those numbers have been going up, Brad. So, I think it's a sort of an unlikely situation where we see sort of a miss and guide lower, but anything can happen. Certainly that would be taken as a pretty meaningful negative, I would say, into the ecosystem of AI as we think about the broader companies that are involved here. But like I said, throughout earnings season, the news has been rather positive on this broadening of capital spending into a lot of other companies that will benefit from AI infrastructure.
Ruben, you mentioned just a moment ago that GPU tech conference that's coming up next month. Any idea, or just give us a sense just about what you think the pipeline updates is going to sound like or is going to look like, and what you think NVIDIA sees in terms of that growth opportunity, the TAM, the total addressable market here for their chips in the longer term?
Yeah, it's a great question because I think that's really a focus area that we've been looking at, which is that NVIDIA is expanding their technologies that are coming into this area of spend. So not just the GPU hardware, not just the software that goes along with it and the networking products that are very necessary, but they're expanding. They started shipping a CPU for the first time into these types of deployments. So they've got an ARM-based CPU. I think that the cadence of their technology coming to market is increasing. So instead of GPUs coming to market every 2 years, they're trying to increase that to potentially bringing out new technologies every year. They've got, as you folks might know, H100 and H200s are kind of the leading edge of the GPUs that are going out into these AI infrastructure builds. Today, they've got a new set of technologies coming out that we expect to be launched later on this year, which we'll probably talk about. And so I think it's really that. It's a question of expanding their technology that they're bringing to the table across both hardware and software, as well as the networking. And so I think that's going to be an important area for investors to focus on.
All right, Ruben, Roy, always great to get your insight here. Thanks so much for joining us here ahead of Nvidia's results tomorrow. Ruben, thanks again.
Thanks for having me.
All right, keep right here on Yahoo Finance. Much more of your market action. Again, you are looking at pressure across the board with all three of the major averages in the red. We'll be right back.
Welcome back. I'm Brad Smith alongside Shauna Smith. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up right now. Stocks are lower today as investors digest mixed earnings, and that data coming from retail giants like Walmart and, Home Depot. We're also keeping eyes on Nvidia's report. That's to come tomorrow after the bell, and the possibility of another AI-fueled rally. It's up in the air. We'll get the ultimate answers on Wednesday.
Time's ticking until we get those results. All right, well, let's take a look at some of the individual trenders here this morning. First up, Intel shares up just about over 1%. Investors anticipating more than $10 billion in subsidies as part of the CHIPS Act. Now, Bloomberg reporting that an announcement could be coming soon. The chip maker is also holding an event tomorrow morning on its foundry business, where we are expecting to hear a bit more. Also, U.S. Commerce Secretary Gina Raimondo is expected to be in attendance. Again, Intel shares up about 1%.
And Medtronic shares are climbing this morning after beating estimates in its third quarter and boosting its forecast. The medical device maker betting on increased demand for its heart and diabetes devices as non-urgent procedures pick up.
And shares of Intercontinental Hotels are rising as it sees its profit jump in 2023 compared to a year ago. Now, the Holiday Inn owner saying that it also expects to return up to $1 billion to shareholders through buybacks and dividends. The stock up just about 8%.
All right, well, we've got a lot that we're watching here today. Shares of Home Depot also among that list after reporting same-store sales falling 3.5% from a year ago. The home improvement company also forecasting full-year sales to grow about 1% in 2024. That's falling short of the street's expectations. Brian Nagel, who is the Oppenheimer Managing Director and Senior Analyst, joins us now. Brian, great to grab some time with you here this morning. There were a few things that jumped out to us about what this means for the state of home improvement more broadly here, but as you kind of look across to the forecast that Home Depot is spelling out here as well, what is the signal for what investors should expect from this company?
Yeah, well, thanks for having me on your show, as always. Look, to me, this was a very blasé report from Home Depot. We got basically inline results for the fourth quarter, and then the initial guidance that the company put out there for fiscal 24 was essentially in line as well. Now, I mean, what my clients and I have been talking about today, these are not normal Home Depot numbers, right? I mean, what you're seeing here is, a weaker trend, this, and I really believe that this is still a very much a post-pandemic type dynamic where so obviously there's dislocations in the housing market, rates are still elevated, and I think we're still suffering to some extent, maybe even a large extent, from a pull forward in demand that occurred in the pandemic. And so as a result of this now, we're basically, if we take what Home Depot said today, we're basically heading now into this second kind of post-pandemic reset year for the company, which is characterized by sub-algorithm growth.
So, Brian, break that down even further, just in terms of, given that challenging landscape, what exactly that's going to mean to Home Depot's bottom line and what necessarily needs to happen in order for a name like Home Depot to regain some of that momentum that it's lost.
Yeah, so look, it's a good question. I mean, Home Depot, as I say a lot, I mean, it's an extraordinarily well-managed company, right? So, I mean, what we're seeing right now is this, more sluggish than normal top-line growth. But, the company's doing a good job managing their margins and expense controls and such. I mean, it's solidly profitable. They generate a ton of cash, right? And there's a lot of levers they're pulling to do that. But to answer probably the more important question, okay, what has to happen here? I mean, in my mind, in order to for Home Depot to regain this momentum, look, I do think we need help on the rate side. This is a rate-impacted retailer. So when we actually start to get lower rates, I know that's debatable when that happens, but I think that will be a positive for the fundamentals of Home Depot. And then secondly, this is what I was talking about before. It's, and this is a little bit of a waiting game. I think we just have to get further away from the pandemic and further away from this pull forward in demand that occurred, and to basically reestablish normal demand dynamics for consumers within this space.
How dramatically do you believe that rate cuts then would change the sentiment of purchasing, would change the entire environment for Home Depot, especially as it relates back to that housing sector?
It's going to be big. I mean, I know that's probably not the most quantifiable answer what I told you, but I mean, look, when we go in, we've seen this historically. As the economy goes into a rate moderating backdrop, that's a big positive for Home Depot and the home improvement channel. So, because what happens there is you get right now in my mind, we talk a lot about just the tie, if you will, between housing activity and sales growth or profit growth at Home Depot. But I mean, the point being, I think we have a housing market in the United States that's largely in a state of paralysis. There's just not much happening right now. Lower rates will help to unlock that paralysis and serve as a driver of better sales at Home Depot.
All right, Brian Nagel, always great to get your perspective here, especially on the heels of this earnings report. Home Depot shares off just about 1%. Brian, thank you. All right, well, we're nearly just about 35 minutes into the trading day. Major markets trading to the downside. We're still seeing some pressure here across the board. The Nasdaq leading the way lower, the biggest underperformer in today's early market action, off just about 1%. But is there some reason to be a bit optimistic? Jared Blicker standing by at the big board for us. Tell us more, Jared.
Shauna, there is reason to be optimistic, and hold on a second here. I just want to point out my first point here is that February tends to be a down month for the markets, for stocks in general, especially in this year of the presidential cycle. But that doesn't mean that we're looking to sell everything. In fact, we've seen some weakness over the last 5 days in some of those market leaders, and we want to figure out what could be leading next. In other words, we have sector rotation going on, and we want to take a look at what is taking the place of these tech stocks. This is a spider sector action over the last 5 days. Tech, by far the worst of the sectors, then consumer discretionary and communication services. Not a coincidence that those are the mega cap sectors. And you take a look at what's happened in the chip space over the last 5 days. We have not seen a lot of bullish action here as well. So what has been working recently? We've seen a number of markets come to record highs only recently, and this is the 5-day total. I just want to start with the Nikkei 225. We'd have to look at a max chart here. This is only now starting to eclipse the highs we saw in 1989, and this could very well be one of the largest cup and handle patterns I've ever seen, with the cup potentially happening later on in this decade. I don't want to get too far ahead of ourselves, but just to point out that markets can come back. Now, healthcare is another interesting one. Let me just dial this down to a 3-year chart. Only recently did we break to record highs. Healthcare is the second best sector of the year, and a lot of that has to do with these weight loss drugs, but there are pockets in there also in biotech that have perked up recently, so that is another industry and sector that deserves some attention. Also, VanEck Vector's oil refiners ETF, these are the guys that make the crude oil, turn it into gasoline, only recently came to record highs here. We saw energy as one of the big plays in 2022, but not necessarily so much last year. But oil is on investors' radars once again. And also want to check out IYT. This is iShares Transportation ETF. You can see it's just barely breaking out of a 3-year consolidation here. One of the big things I like about that is Uber. All the strength we've been seeing in Uber is propelling that to record highs. Interestingly, it's not a part of the Dow Jones transport, so you got to watch your ETFs, but transports in general are another thing I'm keeping my eyes on here.
Lots of other things for investors to potentially buy and bet on here other than tech, the theme that we've been talking about now for quite some time. All right, Jared, thanks so much. Well, we've got much more of your market action ahead. Stay tuned. You're watching Yahoo Finance.
It's no secret, commercial real estate saw one of its most challenging years in 2023. And while the industry grapples with elevated interest rates and economic uncertainty, our next guest says that there's reasons to be cautiously optimistic in the year ahead. Here to discuss is Marcus & Millichap CEO Hessam Naji. Hessam, thanks so much for taking the time here today. What are some of the reasons to be cautiously optimistic?
Good morning. Thanks for having me on the program. The reason is price adjustments. Commercial real estate has proven to be a great investment over time. It's outperformed the stock market in a 20-year time span. It has many tax advantages, of course. But the most important part of our cautious optimism is the fact that we're already a year or more into this phase of an interest rate shock causing value adjustments, and for investors to rethink basically investment opportunities within commercial real estate from sector to sector. And when you look at replacement costs, the cost and the difficulty of adding new space in any property type, whether it's apartments or shopping centers or warehouses, it's become much more constrained and much more difficult to add new supply of commercial real estate. So on a replacement cost basis today, we're seeing that the 2024, 2025 vintage of acquisition opportunities and capital deployment will end up being a very good vintage because of the price adjustments we're already seeing in the market.
Hessam, I think the big question investors are trying to figure out right now and asking themselves is whether or not we've seen the worst of it when it comes to commercial real estate. Because yes, there is reason to be optimistic in the longer term when you talk about the Fed starting to cut rates. But when you take a look at your recent earnings results with revenue falling more than 50%, is the worst yet to come, or have you seen it?
Well, first, you have to remember that our revenue, our business model as a intermediary, advisor, broker to buyers and sellers, and basically a facilitator of financing for borrowers and lenders. As an intermediary, we've had a very difficult time in determining the right value of real estate. There's been the last 12, 18 months, there's been a lot of uncertainty because of the interest rate shock and the market pulling back to try and reassess what the interest rate component means to valuations. That disconnect is the reason you're seeing our earnings being under pressure, our volumes being under pressure. We built a company that is so solid in terms of our balance sheet, in terms of 52 years of learning from these various cycles. It is a cyclical industry. So it is a temporary phenomenon to see this disconnect in the marketplace. And as interest rates either settle or start to come in, either one, by the way, the industry doesn't need interest rates to come in that much to basically get going again. It's the variability from week to week of where the interest rate movement's going to be that's really creating an obstacle for the business. Once that happens and the price adjustments continue, I don't think we're done, to your question, seeing the full effect of the interest rate shock. I think we're more than halfway there. So within the next couple of quarters, we think that price discovery will have run its course, and there will be more certainty related to revaluing commercial real estate in this higher interest rate environment. And that will bring a lot more activity to the market. So is the worst of it behind us? Yes, I'm confident that it is, but it's not a hockey stick recovery. It's still going to take time for some more price adjustments. And everyone is still waiting to see what the Fed does. Of course, the timing of the Fed easing has been pushed back for actually positive reasons. The economy is doing well. The consumer is holding up fairly well. Those are good reasons for the Fed to have to wait. But unfortunately for our industry, it pushes back the timing of that recovery.
Yeah, Hessam, it's no secret, obviously, an extremely challenging time for your industry. There's been so much focus when we talk about commercial real estate. A lot of that focus has been on offices for good reason. But I also want to talk to you just about what you're seeing in terms of the multifamily subsector, because just as the middleman there, what are you seeing valuation-wise and what those challenges realistically look like within multifamily today?
Multifamily historically has been the darling of the industry because of its stability. Everybody needs housing and shelter, of course. The positives on the multifamily side at a macro level, number one, is it starts with a very solid set of internal fundamentals. Occupancies are still very strong. The rents are holding up. Have come down in the last 12 to 18 months, a little bit, after spiking almost 30% in the prior 3 years. So we saw a big spike in rent growth and then somewhat of a pullback. And we're seeing a lot of supply, 400,000 units come to market this year. And that is creating a lot of concern. However, if you peel back and see where that additional inventory is being added, it's mostly concentrated in 10 major metros. And those metros, such as Dallas, such as Austin, such as Atlanta, also happen to be some of the job creation leading metros. So it's not a terrible situation with out of control oversupply, but there is softness in the market. And I'll say that probably the most interesting challenge I've seen for multifamily in 30 plus years of doing work in commercial real estate is that you have the biggest pricing disconnect between buyers and sellers, because the yields on apartments were so low, given that it was the most favored asset class. When interest rates spiked, that created a very large price disconnect in apartments. And then we're working our way through that. That's where my comment about price adjustments and being more realistic about what is the value of any commercial real estate, not just apartments,
right,
has to get reset based on the higher interest rates.
We got to hustle to our finish here, but just lastly, while we have you, what is the largest post-pandemic use purpose shift that you've seen in commercial real estate, and does that materially alter the income profile because of the type of clientele that would be moving into those presences?
I have to say there's record capital on the sideline waiting to come into commercial real estate. We're tracking it. It's near record because there's so much interest in the sector. It just hasn't broken loose yet. As far as property types that have repositioned themselves, I would have to say it's retail, because retail was well ahead of any other property type in the post-pandemic basically dislocation. And retail reinvented itself. Very little new product, a reimagination of brick and mortar retail, and therefore is one of the leading property types coming out of the pandemic.
Sam Naji, we thank you so much for taking the time once again to join us here at Yahoo Finance, CEO of Marcus & Millichap. Thanks so much, Sam.
Thanks for having me.
Well, keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back. Paramount Plus and Peacock reportedly in talks to join forces amid an increasingly competitive streaming landscape. This coming amid several potential strategic options that the entertainment company is pursuing, all according to a report here from the Wall Street Journal. Here with more on the path forward for not only Paramount, but also several of the other media giants, we want to bring in City Managing Director Jason Bazinet. Jason, it's great to see you again. So let's start on that Journal report here from last week. Just give us your assessment just of where Paramount specifically stands. And when we talk about consolidation, whether or not it's inevitable that some of these smaller players need to some sort of combine or bundle up with the larger players in order to better compete.
Well, I'm in the minority. If you speak to most of our institutional investors, they would say that consolidation really makes no sense. And there's good reasons for the buy side to say that. I understand why they draw that conclusion, because we've already seen many rounds of consolidation with Disney Fox. We saw Warner Brothers Discovery. We saw CBS Viacom. And none of those deals sort of was the elixir that allowed them to generate copious amounts of profits in streaming. So the buy side says we're sort of done with consolidation. Even if we see more consolidation, it's not going to help any of these incumbent firms. And I think it's just dead wrong. We need another round of consolidation. It will help these incumbent firms compete with the likes of Netflix.
How will that consolidation then, from your purview, change the pricing mechanisms that these companies put forward to consumers?
You know, I don't think it's so much about pricing per se. I would say that we went through a chapter, I'll call it 2019 through 2021-ish, where it was just give away the product, try and get as many subs as you can to get scale. Mm-hmm. And we're now in a chapter where a lot of these media companies are saying, look, we can't generate losses forever in streaming. We're going to take pricing up. So if we see another round of consolidation, I think pricing will go up for the video streaming apps, but it would go up anyway. What we really are focused on is more about the cost savings that you get with consolidation, and equally critical, just rationalizing the number of apps that are out in the marketplace. We just have too many video apps.
Yeah, Jason, talk to us just a little bit more about what that cost savings perspective, what that's going to do, how much will it really save some of these media players in the long run?
Yeah, typically it runs, a low single-digit percentage of the cost structure of the pro forma firm. So it's billions of dollars, no matter which combination you envisage.
And so with that in mind, I mean, we're already hearing as well that there's going to be some potential pushback from the DOJ if there's more of this consolidation effort that goes forward. Where do you think that companies will have to strike the right tone in their messaging to regulators as well?
Well, I don't know. It's pretty interesting because the regulators have a propensity to almost be too backward looking, right? And so there certainly is some risk that you'll get regulatory pushback. I can tell you the way the institutional investors are looking at it is the real competition is really from the tech giants, right, that are getting into the streaming business, whether that's an Apple or an Amazon. And so the buy side doesn't really look at consolidation as a constraint, but sometimes the regulators tend to be a little bit backward looking, right? And might say there's too much consolidation. But I think that would be the wrong answer.
Jason, we had the chance to have Paramount CEO Bob Bakish on recently and told Yahoo Finance on the company's views to meeting consumer needs in the media landscape. Here's what he had to say. I want to get your reaction on the other side.
Sure.
Broadcast is key. Broadcast provides you wide reach. And you see the numbers on CBS this year. And I think all leagues are looking at the power of broadcast and wanting to be part of that. But we also, we dual eliminate. We use broadcast and the fastest growing streaming service in terms of net adds since launch, Paramount Plus, to provide that choice for consumers. And that is the root, and that is success in today's media landscape. Frankly, both parts are important to serving audiences.
And so just want to get your reaction to that as well here with the kind of additive that, this could readjust perhaps some of the margins that we've even seen or come to expect over the years. There have been some activist campaigns that have even targeted Disney, for instance, on making sure that they can achieve what everybody's chasing, Netflix-like margins. So I want to get your reaction there and what this all trickle through all means in terms of the trickle through to margins as well.
Well, Netflix's streaming margins are about 24% is what they're targeting. Disney publicly said on their last earnings call that they're aiming for double-digit streaming margins. Those are nowhere close to the old margins of the linear ecosystem where you'd see, 30, 35, 40% margins. So I don't think anyone is expecting us to go back to the old margin structure, but as you rightly pointed out, sort of Netflix is now established best in class in the streaming side. And I think for a lot of these companies, including Disney, they're all still losing money on their streaming business. I mean, Warner Brothers would take exception with that because they include the legacy linear HBO business in their streaming definition technically, but I think on a true streaming business, everyone's losing money in streaming, and that's what needs to get fixed.
Yeah, Jason, speaking of Warner Brothers Discovery, we're going to be getting quarterly results from that company here in just a few days. You mentioned debt, you mentioned subscriber numbers here. What is the one thing or the one or two things that you think is the most important for investors to focus on in that report?
I think the most important thing that the buy side is focused on right now is free cash flow generation coming out of Warner Brothers. With the singular goal of paying off their debt, right? The market is saying that Warner Brothers has too much debt relative to the trajectory of its business. And so it's all about how much EBITDA do you generate, how much of that EBITDA is converted to free cash, and how much of that free cash flow can be used to pay down debt. And that's going to be the story on Warner Brothers probably for another 2 years.
Citi Managing Director Jason Bazinet. Jason, a pleasure to get some of your time and insights. Really appreciate it.
Absolutely. Thank you.
Well, we're looking ahead to Nvidia earnings after the bell tomorrow. Here's a look at what investors can expect.
Nvidia is Wall Street's AI darling. The company's stock price is on a massive bull run, rocketing 380% since the end of 2022, and was the best performing component of the S&P 500 in 2023. With that said, here are 3 things we'll be watching for when the chip giant announces its fourth quarter earnings on February 21st. Artificial intelligence. Nvidia is the tech industry's go-to provider for the powerful graphics processing units used to train and run generative AI models. Heck, Meta CEO Mark Zuckerberg announced that his company will purchase an incredible 350,000 Nvidia H100 cards by the end of 2024 at a price tag well into the billions of dollars. Microsoft, Google, Amazon, Tesla, you name it, every company is clamoring for Nvidia's chips. And those are just the tech giants. Smaller firms are also working to get their mitts on Nvidia's offerings. And with the earnings season already showing continued AI investment across the tech industry, Nvidia stands to continue to gain considerably. Market expectations. Expectations for Nvidia's fourth quarter are sky high after the company stunned Wall Street in the prior period when revenue rocketed an incredible 206% year over year to $18.12 billion. In the fourth quarter, the company is projecting revenue of $20 billion plus or minus 2%, well above analysts' prior expectations of $17.8 billion. And Wall Street doesn't see the growth stopping anytime soon. Bank of America recently raised its price target in Nvidia from $700 to $800. Goldman Sachs also raised its price target for the company to $800. It previously had a price target of $625 on the stock. Regulation and competition. Still, it's not all smooth sailing for Nvidia. The company is contending with U.S. export restrictions, blocking the sale of some of its high-end chips to China, one of its largest markets. And while that isn't hurting the company for now, it could mean the chip giant misses out on potential future sales. Then there are rivals. AMD and Intel are slowly but surely building out their own high-powered AI chips, with AMD in particular gaining on Nvidia's tail. That company says its latest MI300X chip can go toe-to-toe with Nvidia's H100, a claim Nvidia refuted via a blog post. Even Nvidia's own customers, including Microsoft, Google, Amazon, and Tesla, are building out their own AI chips, which could cut into the total addressable market for third-party AI chips. Still, those threats are relatively distant at this point. Nvidia is still riding high at the moment, and we'll find out if it can keep the hype train rolling when it reports its results February 21st.
Nearly 9,000 auto workers may go on strike this week. The United Auto Workers Union is threatening to go on strike at Ford's most profitable factory. Breaking this all down for us as Yahoo Finance senior autos reporter Pras Subramanian. Pras, I guess how big of a deal could this potentially be for Ford?
You know, this news kind of flew under the radar late Friday into the long weekend, right? And basically, this is their, like you said, their most profitable Super Duty truck plant, big trucks, big SUV, big vans even. Ford has said this is their most profitable easily for their company. The Ford Pro business, of course, very, very focused, highly focused on among investors because of its like sort of their new profit center. So this is a big deal. Now this has to do with the local union laws, not necessarily the overarching general agreement that they did earlier. So these local sort of union agreements happen or pop up here and there. They usually aren't always agreed upon, but in this case, it seems like the union is insisting that these get actually put in place because it's what happened the day before this happened. Ford CEO Jim Farley was at a mobility conference and said something to the effect of, "Our relationship with the UAW has changed. We've got to rethink our manufacturing footprint." And he cited the Kentucky truck shutdown during the stand-up strikes as a big problem.
Yeah, certainly. We're seeing some pressure on the stock here this morning, but certainly it sounds like a story worth keeping on your radar here in terms of the broader implications that this could have to Ford. All right, well, Pras, stick around because we want to talk a little bit more about the broader landscape. A common theme for automakers this past earnings season is disappointing electric vehicle demand. Higher prices, concerns about public charging infrastructure, among the long list of reasons that is keeping potential buyers on the sidelines. Now, despite all this, our next guest is still bullish on the sector. He has a number of names that top his list for the best auto plays. We want to bring in Brian Sponheimer. He is a Gabelli Funds portfolio manager. Brian, it's great to have you here. Pras Subramanian still with us on set. But Brian, let's talk about the top plays within the sector, because I think declining demand for EVs, that was one of the overall narratives that came out of this past earnings season. Is some of those fears, is that overblown at this point?
Well, I think we have a situation where the pace of innovation has, in many ways, moved faster than the expected adoption curves for these technologies, particularly on the electric vehicle side. So, automakers find themselves asking critical questions about their development. I think that the electric vehicle future is an inevitability. I think the question has really become it's a matter of when, and that when keeps getting pushed out. And that's something that we've always felt here. A lot of the excitement, a lot of the enthusiasm for electric vehicles is really centered on early adopters to start. Some of the use cases I think that are coming forward or that are really exciting aren't necessarily in the traditional light vehicle market. But as we kind of look forward, I think we're fairly excited about what's going on in the internal combustion engine portion of the market, and really kind of the push out of what that means for the broader ecosystem. So, we are seeing growth in electric vehicles, just at a slower pace than would otherwise have been expected.
So Brian, Pras here. So talking about the big three in particular, you note that the adoption curve hasn't really happened as much as they would like it to, or they're deeper as much as they wanted to. What did they get wrong here, and what can they actually do to kind of course correct and make them better plays?
I don't necessarily know that they've done anything wrong per se. They needed to have the products ready to go. The fact of the matter is that we're in this period now where tens of billions of dollars are really being spent on an annual basis by the big three towards electric vehicle production, and it's coming with an uncertain outcome as far as if those vehicles will be adopted and when. But the reality is they need to be there. They need to be there from a customer standpoint eventually, but they also, from a government standpoint, need to have invested this capital to right size their own vehicle framework over the course of the next decade. What we're going to see, though, and this has really kind of borne itself out, whether it's GM, whether it's Ford, and whether it's Tesla, is that the CapEx is going to be high, cash flow is going to be lower, and the margins are going to be lower than they would have otherwise thought. So that's the reality of the situation right now for the automakers. It's created some nice opportunities elsewhere in the automotive ecosystem, but right now it's a relatively difficult time from a last 15 years basis for the traditional automakers.
So during that relatively difficult time, one of the areas, at least within your portfolio and investment thesis here, it really leans into predictable resiliency. Where does that lead you to in terms of specific names?
Sure. So for better part of 45 years, our firm, led by Mario Gabelli, has followed the auto industry. We've held a conference in Las Vegas showcasing the automotive aftermarket. So there's about 285 million cars on the road in the U.S. That compares to the 16 or 17 million that gets sold from a new vehicle basis. So, we really think in terms of the life cycle of a vehicle. It's taken us to great places, great investments like Genuine Parts over the course of the last 45 years, O'Reilly, et cetera. But we like the dealer space, specifically a company like an AutoNation. That's the second largest dealer group in the U.S., ticker's AN there. It is a business that is growing its after sales or its parts and service business by low double digits, while it services the vehicles that it sells over the course of the last few years that are becoming more complex. Everything from active safety to advanced propulsion to infotainment systems. These are becoming more difficult for the traditional aftermarket to fix. So a company like AutoNation, which will still sell through traditional dealerships, new vehicles and used, is really taking advantage of what is the profit center of that dealership group to really grow that parts and service business, drive free cash flow, expand the business, and ultimately buy back quite a bit of its own stock in the process.
So Brian, looking at broadening out the big automakers, right? As a value investor that Gabelli Funds focuses on, when do the automakers look interesting for you guys as an investment?
It's a really good question. Automakers traditionally have been cheap from a statistical standpoint. We're really looking for what the catalyst can be for these stocks over the course of the next 5 to 10 years. I think you have to look in terms of initially price, and it's hard to say that GM at 5 times earnings or Ford at 6 times earnings is expensive. But the real question, as a value investor, you have to ask yourself is when do you just say it's cheap for a reason? And I think I'm not ready to say that exactly, but I think given the amount of capital investment that needs to come into these industries over the course of the next 5 years, given the lower margins we're going to see, Ford, to their credit, is showing the amount of investment and negative income that comes from the Ford E movement. I think it's difficult as a value investor to really say right now that this is the right time. The shares were to take a 20% dip, then that might change just from a trading perspective. But we are really looking for catalysts in stocks, and it's hard to see that right now for the traditional automakers.
So should investors be buying the dip, per se, in Tesla at this juncture?
Tesla's a really interesting situation. Again, we are a value investing community at Gabelli, and you're talking about a company that you really need to have confidence that there is a piece of the Tesla story that goes well beyond traditional automaking. Stock is going to earn somewhere between $3 and $3.50 or $4 for this coming year. And if you're thinking about a stock trading just below $200, what are you going to be paying 45 or 50 times earnings for? Is it for a decelerating top line in its traditional auto business? Is it for the potential down the road for there to be robo-taxis? Is it for AI? While Tesla shares have declined over the course of the last year or so, we're not necessarily ready to say that it is a value stock. It's certainly become more interesting at these levels than it has been in some time. And I do think that, for a company that is going to be the leader in electric vehicle development over the course of the next decade, there are some really exciting things going on, but can't definitively say that there's a price that I'm loving diving into to Tesla unless I really believe that there is an an AI story here that I want to invest in.
Yeah, well, certainly here, when that excitement turns into earnings and realization there is what a lot of investors are going to be trying to. Yeah, exactly. Two different things there. Brian Sponheimer, who is the Gabelli Funds portfolio manager and our own Pro Supermania. Thanks so much for the conversation. Appreciate it.
Thank you very much for having me.
Certainly. We're also watching shares of Nvidia ahead of its much anticipated earnings report after the bell tomorrow. Here is a look at how the company got here.
From creating graphics cards for gaming to becoming one of the world's leading AI chip companies, it's safe to say Nvidia is officially one of the tech giants. In 2023, the company generated nearly $27 billion in revenue, and its market value is well over $1 trillion. Let's take a closer look at what led to Nvidia's boom with Beyond the Ticker, where we dive into the company's biggest moments. Nvidia was founded on April 5, 1993 by Jensen Huang, Chris Malachowski, and Curtis Priam, with a vision to bring 3D graphics to the gaming industry. In 1997, Nvidia launched its first hit product, the NV3. It would later go on to sell a whopping 1 million units in its first 4 months of availability. On January 22, 1999, Nvidia went public via IPO at $12 per share. And in 2000, Microsoft chose Nvidia to develop the graphics hardware for the first Xbox console. 5 years later, Microsoft's rival Sony chose Nvidia's hardware to power the PlayStation 3. In 2010, Nvidia became the graphics chip supplier for automaker Audi. And in 2015, the company launched its Nvidia Drive chip for powering driver assistance technologies. In 2016, Nvidia kicked off its AI efforts with the launch of the DGX-1. 2 years later, the company debuted Nvidia RTX, the first GPU capable of real-time ray tracing. That same year, Google announced it was using Nvidia's Tesla P4 graphics cards for its Google Cloud platform. In 2022, Nvidia debuted its H100 graphics chip for AI, which still stands as one of the world's most powerful chips for artificial intelligence apps. And in May 2023, Nvidia eclipsed the $1 trillion market cap mark, joining the ranks of mega companies like Apple and Microsoft. The stock continues to surpass its all-time highs over the past month and is currently trading at over $700 per share. From a company of 3 engineers working on graphics cards to thousands of employees working on chips that will power the AI supercomputers of the future, Nvidia remains at the top of the tech industry.
Coinbase shares are lower this morning, taking a breather after surging Friday on solid fourth quarter results. I had the chance to speak with Kate Rue, who is the Coinbase Chief Marketing Officer at the NBA All-Star Weekend in Indianapolis. This is what Kate Rue had to say about the role that marketing played in these results.
So, at Coinbase, we've always been focused on breakthrough creativity in our marketing ever since we went with our first national television ad, which was actually the Super Bowl 2 years ago.
The QR code, everybody remembers.
The bouncing
Iconic
QR code,
yes,
yes exactly. And so obviously that was a participatory campaign, an ad where people could engage. And that's just really a through line we've brought through to our marketing ever since, including the activation that you see behind you today.
And again, that was the CMO of Coinbase, Kate Rue. And we were speaking there really about how much the spend that Coinbase has put into marketing is actually translating into some of these figures that the company has pointed out within their highlights most recently in this past quarter, where they swung to a profit. Investors rewarded that. I believe on the reaction, we saw shares jump by about 8%. We mentioned the breather that was taking place here today, but quarterly volume traded $154 billion there. And it's going to come back to retention and then also some of the other services that they continue to see customers come into, namely custodianship as well here.
Yeah, I think that has been a theme that we've really seen play out over the last several weeks. And we really saw so much hype and excitement surrounding the SEC's approval of the first spot Bitcoin ETF. We saw a lot of that being already baked into some of these prices here ahead of the actual approval. But we are starting to see more and more retail traders. When you take a look at Coinbase's results, when you take a look at Robinhood here, seeing that jump in trading activity here by individuals. They are now a bit more bullish on some of those opportunities that they're seeing within some of those bigger crypto players. And then you couple that with the marketing spend and what so many of these companies are doing. Names like Coinbase are getting out and they're getting more NBA fans in theory on board with crypto and investing in crypto, more comfortable with that, since it is still relatively new to many investors. So we're starting to see that trickle through. And I think now the big question is whether or not they're going to be able to retain that interest, given the fact that regardless of reasons to be bullish, obviously a lot of volatility plays out within the sector.
Yeah, you mentioned the annexation to the NBA. Of course, this was one of the first major crypto partners that the NBA saw flow in at the same time that you saw a lot of inflows into crypto back in 2021. Now, some of those partnerships have waned or sunset, but Coinbase, that partnership's still running strong. We also had the opportunity to speak briefly about this year for global elections. Record number of people heading to the polls, and Kate was optimistic, especially considering the fact that over 80% of crypto trading happens outside of the United States. So crypto, even outside of the U.S., could be on the ballot in certain regions where there is more focus on what the future of currency looks like as a hedge against some of their own inflationary pressures that they may be seeing in certain regions.
Yeah, again, the surge that we saw on Friday was extremely dramatic. So some of the losses that we're seeing today is just to give back of some of the optimism that we saw push the price higher on Friday. All right, well, also another update here. The patient who underwent Neuralink's first human trial back in January can now reportedly control a computer mouse just by thinking. That's straight from the company's founder, Elon Musk, the founder of Tesla here, who had provided an update last night during a Spaces session on the social media platform X, formerly known as Twitter. But this is a massive milestone. It's hard, Brad, you and I have been talking about this all morning, just trying to wrap our heads around this, just in terms of how big of a step, how significant this is for the technology. And Elon Musk went on to say that the progress that they have seen so far, comparing that to what they set out to achieve, is, quote, good. He also went on to explain the fact that the patient is suffering, quote, no ill effects that the company is aware of just yet.
I mean, mind blown here at the end of the day. You think about what additional advancements this could really kind of permeate out to even further here. Of course, the focus initially on making sure that for anyone who had a disability that kept them from being able to operate, certain limbs or parts of their body, that this perhaps could be a way forward. Now, there's a larger question, too, of where else this could play out in science and medicine as well. I mean, but at least on the onset of just hearing some of the early successes, I mean, many of us having the same reaction that our stage manager, Mike, did, where we're just sitting here, SMH, shaking our head, trying to figure out how this is possible, but we're getting even more data to come forward. It'll be interesting, though, to see further how some of the testing gets expanded. This is just the first patient, but you got to wonder, okay, who else is going to raise their hand, step forward, and ultimately feel comfortable enough in some of the early phase trials there, too.
Yeah, certainly. The company previously saying that the implants would allow people to be able to complete tasks just using their thoughts. So certainly this seems like a step in that direction, also helping treat a certain medical condition. So an amazing step forward here for this technology, at least what we know so far. All right, let's do a quick check of the markets here. Just about 90 minutes into the trading day. You're still looking at pressure across the board. Technology is the worst performer in today's trading action. You got the Nasdaq off just about 1%. That does it for us, but keep it right here. Rochelle Akufo and Akiko Fujita have you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo alongside Akiko Fujita. Here's what I'm watching this morning. Walmart and Home Depot kicking off this week's earnings reports on this shortened trading week. The new batch of quarterly results from big box retailers providing investors more color on the consumer. We'll get the details just ahead.
And sticking with earnings, Wall Street eyeing Nvidia as it gears up to report its fourth quarter results on Wednesday. Nvidia, the last of the Magnificent Seven to report earnings this season. Will the chipmaker continue to blow past expectations?
And a new deal sparking buzz in financials. Capital One to acquire Discover Financial in a $35 billion all-stock deal. Now, this merger combines two of the biggest credit card companies in the U.S. We'll have more on this story just ahead.
First, though, let's take a look at where markets are trading 90 minutes into the shortened trading week. A bit of a catch-up session, you could argue, if you look at all three major indices right now. The Dow trading pretty flat, although just dipping into the green there. The Nasdaq, the biggest laggard on the day so far, down about 151 points. We are watching Treasury yields as well as we continue to see some shifting expectations around when the Fed will begin that rate cutting cycle. The 10-year yield pulling back just slightly there. 4.25% is what we're looking at right now. On the longer end, the 30-year yield at 4.42. The big story of the shortened trading week, though, is, of course, earnings. Goldman Sachs is boosting its year-end target for the S&P 500, citing an improved earnings outlook. And we got a good gauge on the consumer from big box retailers, Walmart and Home Depot this morning. It is all about Nvidia. Those results out after the closing bell on Wednesday. And Rochelle, some interesting moves ahead of those results. Take a look at where Nvidia stock is trading today, down about 5% right now. I mean, you could argue this is a stock that has been really priced for perfection. Blowout earnings over the last several quarters, maybe a bit of profit taking happening there as well. And maybe investors getting a bit more cautious about whether, in fact, Nvidia can meet expectations. It's worth pointing out this specific number, though, from Vanda Research. Nvidia trading volumes have made up an average of roughly 8% of daily trading volumes. That's more than Tesla at 7%. So that shows you how honed in investors are on this particular stock. And we're going to get those results tomorrow. Could be a big mover.
I mean, you have to figure, given all the hype going into this, given its meteoric rise just over the past few years, ever since the generative AI boom continued to launch last year, so much seems to be riding on this earnings data. And if you actually look for the last 7 years, Nvidia has actually beaten on earnings per share estimates, sales estimates, and raised guidance every quarter, except for a revenue miss in 2019. And that was, of course, even before what we've seen with the developments with generative AI. I mean, some of the pullback that we're seeing, as you mentioned, perhaps some caution, perhaps some profit taking, perhaps, a healthy pullback, considering, stocks can't just go up and up and up because then you end up with a bubble. So perhaps a bit of a bit of a pause here, and obviously seeing some of the other chip makers falling in solidarity as well, but we'll continue to track that. We've also got some insight into the state of the consumer this morning with Home Depot and Walmart results out before the bell. Now, we heard some consistent themes from both companies that we heard throughout 2023. A more choiceful consumer, pulling back from big ticket purchases, but still consistently spending. For more on this, we turn to Michael Baker, D.A. Davidson Managing Director and Senior Research Analyst. Good to have you on this show here. So walk us through what we're seeing and what these earnings are telling us about the state of the consumer and what they're still willing to spend on.
Yeah, the consumer is resilient, and in fact, maybe even a little bit better than we thought a year ago. If you recall, about a year ago, there were concerns that 2023 was going to be a recessionary year. I think the odds were from a number of economists that we would fall into a recession, and of course, that hasn't happened. Now, who knows what happens in the future, but it seems like the idea of a recession is a little bit less on the table now than it was, because consumer spending was pretty strong throughout 2023, slowing certainly from the pandemic years, but held in pretty strong. Walmart had a pretty strong holiday season. Home Depot remains negative, and that's more a function of I think housing trends, but less negative than they have been. So we're sort of leveling off, I think, in terms of consumer spending.
In terms of, from a stock perspective, Michael, is it still about those names that are most diversified, like a Walmart, that really are best positioned in this environment? Yes, the consumer is resilient, but becoming a little more cautious. You look at a name like Walmart versus a Home Depot, where there is a bit of a pullback in spending, especially on home upgrades.
Yeah, I think it's just being where the consumer is. And right now, the consumer is not spending as much on the home. So that's a much more difficult place for any retailer. But the consumer still is spending on basic everyday needs. Walmart is well positioned there. In fact, probably better positioned now than they have been in the past several years. And we see that in their share gains. That not only are they growing their comp sales, but they're growing their comp sales better than industry trends. So Walmart has done a lot to position themselves. We're seeing it a lot with higher end consumers to position themselves as a good option for consumers with a little bit more spending power than they had in the past. A lot of that is driven by convenience, and that convenience is driven by their improving online capabilities.
And so, Michael, I mean, we are seeing them, especially when it comes to Walmart, spending on the groceries and the essentials, pulling back, though, on some of the discretionary spending. Is that a trend that you expect to continue regardless of what the Fed does?
I think so, but again, I think it'll sort of moderate in 2024. Now, Walmart, their trends in general merchandise, as an example, were negative, but units are actually up. A lot of that negativity is because they are seeing deflation in those general merchandise categories. So as we're seeing that unit trend get better, that does give us hope. Now, we do think the mix for 2024 will continue to skew towards food and consumables, but maybe a little bit less so than it has been, as we think, first of all, we're going to get a little bit less inflation, still inflation in food, but we are seeing disinflation, so that'll be a little bit less impactful. And we think some of the remodels and the like that they're doing in their stores are going to drive better unit trends in general merchandise sales.
Michael, specifically on Walmart, I'm curious to get your take on this $2.3 billion buy in TV maker Vizio. Obviously, this is an ad play, more real estate when you look at the smart TVs that Vizio offers. How significant is that upside, at least in the medium term, for Walmart's ad business?
Well, the ad business is really important to them, obviously. They helped us quantify it a little bit here. It was $3.4 billion in sales, which is actually pretty small, about 0.5%, but much higher margins, at least double-digit margins versus the regular business. So advertising is obviously very important. How much the Vizio helps that, hard to quantify, but it certainly should help. And in that advertising business, along with several of their other alternative businesses, as they call them, things like the marketplace and others, are significantly higher margins. And that really gives Walmart the fuel to continue to invest in price, but still grow profits higher than sales, i.e. grow their operating margins because of these strengths of these higher margin alternative businesses. And this Vizio deal just adds to that.
And so, Michael, as we look at Home Depot and some of its competition, including Lowe's, where is the upside going to come from, especially as people aren't moving out of their homes at the same speed and people are sort of stuck in that mortgage rate cycle?
Yeah, well, generally it is a macro play. What we have found over time is the biggest driver to home improvement spending is actually home price appreciation. Now, of course, that is a function of turnover. As you have more turnover, pricing sees pressure upward, and that helps spending. But it really is about home price appreciation, which actually has started to level off. And over the last 4 months, home prices have been up year over year. That's after declining in the earlier part of 2023 off of pandemic highs. But really, the upside in those names is going to come from lower rates, which is going to drive better housing trends, which is going to drive upward pressure on pricing. And that's ultimately what's going to help those guys return to positive comps in our view.
Michael, more retail results out this week, but give me your top play right now when you look at the overall sector.
Yeah, we've talked about top names for the year from the bigger box retailers that we cover as being Ulta and Dick's Sporting Goods. We've also talked about names like O'Reilly and Walmart being preferred or buy rated names. We do have an initiative called Best of Breed Bison, in which we highlight top longer term ideas. And within that bucket, names like O'Reilly, Ulta, and also Tractor Supply are the names that we prefer. That's over a 3 to 5 year time frame.
Michael Baker, D.A. Davidson Managing Director and Senior Research Analyst. Good to talk to you. Appreciate the time.
Thank you.
Well, the big deal today, Capital One saying it will buy Discover Financial in a $35 billion all-stock deal, creating a giant credit card network, giving both companies a leg up to compete with giants like Chase and American Express. A big deal to kick off the week here, Rochelle. Obviously, Capital One this combined company would allow them to compete with the biggest or the most dominant payment networks. But I wonder if you can put out this chart that points specifically to the processing volume, because that shows you where the competition stacks up right now, not just against the credit card companies, but also the bigger banks. You see Chase at the very top there, American Express, Citi, and then Capital One at number 4. So and there's a big if here because they still have to get regulatory sign off, if this deal goes through, could be a big shakeup in the space.
It's true. I mean, and it's expected, at least Capital One estimates that this is going to close late 2024 or early 2025. Worth noting, because it's always good to sort of look at some of the bigger investors here, Berkshire Hathaway as its 7th largest shareholder in Capital One. A lot of people are wondering, what does this mean if you're a card holder? Now, at least at this point, obviously, as we mentioned, regulators are still going to have a close eye on this. Don't expect any changes anytime soon. But in terms of how this synergy might work, some analyst feedback here, David Robinson, who's head of the Nielsen report, that's a payment card industry trade journal. He was actually saying he sees good synergy because Discover cards mostly focus on cashback cards. Capital One, it's sort of a variety of rewards there. And he says, this might allow for better programs for consumers. And then from Baird Equity Research, they said that could also mean better cost cutting. When you have a company that big with that sort of scale, you get both of the benefits and perhaps could do some trimming there in terms of cost. So definitely an interesting one to watch. I'm sure regulators, of course, always watching closely with these.
Yeah, the biggest deal announcement so far this year, but you do have to wonder if this is kind of a sign of things to come, something we've been talking about for some time, whether the M&A activity really starts to kick up as well. Well, it is time for today's trending ticker. GlobalFoundries shares on the rise in the pre-market after receiving a $1.5 billion grant from the Biden administration. Let's talk about where it's trading in the session right now, up 1.77% here. We're looking at the other semiconductor shares as well, Rochelle, because when you think about where this is coming from, it all stems from the CHIPS Act. And that was in 2022. It's taken a while to get these subsidies off the ground, but GlobalFoundries getting that first big announcement. Intel also expected to get a huge chunk of the subsidies. Bloomberg reporting that the company is in talks with the administration to get roughly $10 billion in subsidies, which would be certainly significant when they're trying to expand in places like Ohio. And then, of course, TSMC and Samsung, the biggest chip makers out there, expected to get a big chunk of that as well. So we're starting to see some of that money move a few years later, but certainly going to be a big bump for some of these companies.
It's right. I remember when Intel stock took off after that, the CHIPS Act was first announced, and then it was, but when is it actually going to happen? When are we going to start seeing some of these funds get distributed and start coming into play here? Interesting with GlobalFoundries, a lot of what they manufacture, the sorts of chips that they manufacture for national security and key areas of the economy, so communications and auto sectors. So definitely the more sensitive areas of the economy. So we'll be looking for some of that nuance as we look at the biggest beneficiaries from some of this funding, Akiko.
Of course, and all of this is to bring chip manufacturing back to the U.S. The U.S. just has a very small chunk in terms of what it manufactures right now. Well over 80% still very much concentrated in Taiwan and, of course, TSMC.
Indeed. We'll see if they get that leadership role in semis back. Obviously, a lot riding on it for a lot of economies that are looking for that high-end growth, and a lot of it riding on AI and some of this high-end capability that we're continuing to track here. All right, well, stay with us because next we'll be taking a look at the energy sector. With oil prices on the rise, what names should investors be keeping an eye on? That's next after this break. Oil prices falling today, but are hovering near 3-week highs amid rising demand out of Asia and as troubles between Israel and Hamas persist. Let's bring in Yahoo Finance's Inez Ferret to tell us more about what we're seeing here. Hey, Inez.
Hey, Rochelle. Yeah, and we did see over the last couple of weeks a steady decline when it comes to oil prices, even though today we're seeing prices dip a bit. But nevertheless, we are looking at prices that are around a 3-week high. You have global oil demand, which for the month of December grew by more than 500,000 barrels per day in December from November. That's the 8th monthly record for 2023. This is data that individual countries report. And you had rising demand out of Asia, particularly China. You also had global jet fuel demand that also has been rising. If we take a look at our Wi-Fi Interactive, you'll notice year to date, you've got Brent crude, which is up more than 8%. You also have WTI that's up about 11%. I want to also mention that the Russian oil minister, he said that Russia plans to stick to its export curbs in order to comply with OPEC's production cuts. Remember, those are still going on. And then you've got the tensions in the Middle East, which are also creating a lift for oil prices as you have tensions around the Red Sea area as well. Want to mention also in the last week or so, we did get the EIA forecast for U.S. production. That's supposed to slow this year. So you're not supposed to see those record production numbers from December 2023 until 2025. So that should also lift oil prices and the SPR. The U.S. is refilling the Strategic Petroleum Reserve. The Department of Energy announcing that it has already bought about 23 million barrels. That's a fraction of what they need, but nevertheless at around just north of $76 per barrel. So all of this has been helping to lift oil prices, Rochelle.
Okay, Inez, I'll pick it up from here. Thanks so much for that. Well, oil prices remain high, as Inez mentioned, staying close to 3-week highs on rising demand from Asia and the continued conflict between Israel and Hamas in the Middle East. And big names like BP, Chevron, and Shell have all reported their second highest annual profit in a decade on increased production. Let's bring in Kim Fustier, HSBC Oil Gas Research Director, to discuss how to navigate the energy space. Kim, it's good to talk to you today. Are there additional tailwinds here that could push the profits higher, or is this as good as it gets?
Thanks for having me on the show. I think, as always, oil and gas prices will be really key to the sector outlook. If you look at consensus for Brent this year, it's already about $82, which is bang in line with spot prices. So right now, we can't count on earnings upgrades to lift the sector higher. In the near term, we do think oil prices can be supported around current levels or even rise if there's further escalation in the Middle East. That said, let's not forget that OPEC has ample spare capacity, over 5 million barrels a day, and that should cap the upside maybe around $85 or $90. In the second half of the year, in fact, we expect oil prices to slide back under $80 when OPEC and Saudi Arabia bring volumes back to the market. I think I should also mention another downside risk for the sector, which is natural gas prices. Prices in Europe have fallen back to almost normal levels just 2 years after the 2022 energy crisis, and that's really surprised us. Also in the US, natural gas prices have cratered recently because of warm weather. But if you take a step back, in this environment, it's still a very solid macro environment for the oil and gas companies, and they're still able to return a 10% total distribution yield, including dividends and buybacks. Balance sheets are in pretty good shape, so companies are able to absorb short-term macro volatility.
And so, Kim, with that in mind, then, who are your top picks, your top 3 picks here in the oil sector?
The energy sector as a whole is cheap and unloved. And so we would expect the sector to re-rate if the companies are able to demonstrate good performance quarter after quarter. Our top 3 picks are BP, Shell, and Chevron. So for BP and Shell, we think they're good rate of change stories. They've got new leadership teams. BP surprised positively at Q4 results by giving much more visibility and stability in its quarterly buyback program. Shell is also executing better and becoming more consistent. And then Chevron, we think, is a good growth story where its organic growth has been further boosted by the Hess acquisition. and it trades at a decent discount to Exxon.
Kim, the broader narrative within the industry has really been about this transition, or whether, in fact, there will be a significant transition away from fossil fuels. You named BP as one of your picks there. I mean, this is one of those companies that has been more aggressive in that transition into clean energy under previous leadership with Bernard Looney. Is that diversification important as you sort of assess where these companies are going to proceed, at least in the medium term? How significant a headwind or tailwind does that provide?
I think if we take a step back, global oil and gas demand is still growing. We can see that in the statistics. And so despite continued pressure from ESG investors, particularly in Europe, the European majors, including BP and Shell, recognize that. And so they have to strike the right balance, really, between being forward-leaning, investing into clean energy, but also making sure that they've got viable businesses and continuing to invest in oil and gas. And that's exactly why you've seen both BP and Shell tilting back towards growth in oil and gas, at least in the medium term for the next 2, 3, 4 years. And then at the same time, pulling back from renewables, but not abandoning the renewables altogether. Renewables still represent something like 20% of BP's and Shell's capital investment programs. So that is still definitely something that investors need to continue to care about.
And Kim, in terms of both on the supply and demand side here, where do you think that's going to be coming from, especially people still waiting for that China demand to unlock?
I think what we saw last year was probably the last of the post-COVID rebound in oil demand. We can't possibly expect that to happen again in 2024. There is no more pent-up demand that needs to come back from the COVID lockdowns. So I think what we're going to see this year is much more of a steady state on-trend growth in oil demand. We're forecasting 1.3% growth in oil demand, and that can be entirely met by OPEC as well as non-OPEC sources, including U.S. shale, as well as Guyana, Brazil, etc. So as time goes on, it is going to be harder and harder, we think, for OPEC to continue to maintain control over this oil market. They've got 5 million barrels a day of spare capacity on the sidelines that will need to come back at some point in time. And at some point, it will become an overhang.
Kim, finally, I wonder how you assess this pause in approvals of LNG exports coming through from the Biden administration. Certainly a lot of pushback coming from the sector here. But, at least in the short term here, what does that ultimately mean for prices?
Well, the first thing to say is that existing and under construction U.S. LNG projects are not affected. It only affects projects that have applied but not yet received approval. So the near-term impact really on prices is minimal. The U.S. and Qatar are driving a big wave of capacity additions, and the LNG market is going to be oversupplied probably from about 2026 onwards. And so the impact of the ban will very much depend on how long it lasts. A 1-year delay is not a game changer, but a longer pause could affect new LNG supplies in the longer term. And then that could tighten the market. It could also damage confidence in US LNG, and it could benefit projects outside of the US, in the Middle East, in Africa, maybe even Russia. From a domestic perspective, let's not forget that LNG exports had a few useful benefits. They made it easier for producers to produce oil from gassy shale formations because that gave gas a place to go. So the longer the ban stays in place, the more you'd expect US gas prices to stay low because they have nowhere to go. That's not great for domestic producers, but it would be good for companies that are able to play the arbitrage between US gas prices and international gas prices.
And we do continue to track that natural gas year to date, down about 38%, continuing to see that pressure. Appreciate you joining us with your insights. Kim Fustier, HSBC Oil Gas Research Director. Thank you so much.
Thanks for having me.
All right, we have all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
Well, stocks edging lower today, with the Nasdaq seeing the biggest losses on the day, down more than 1% here. This coming after major indices posted their first losing streak in more than a month on the back of hotter than expected inflation data. Our next guest says inflation in services remains the biggest risk to interest rate cuts. To break it down for us, Michelle Kluver, Global X Senior Portfolio Strategist, joins us this morning. Michelle, good to talk to you today. When you look at where those services inflation came in, up 0.7% in January compared to the 0.4% in December. A big chunk of that was in real estate. To what extent has that changed your outlook on the Fed, or where you think the Fed is going to move?
It hasn't changed my trajectory or views on it yet. Obviously, one hot data print doesn't make a trend. Also, with it being January data, this can be impacted by some more seasonality factors. But we are certainly keeping an eye on future inflation prints because we really do want to see disinflation moving into the services areas, and particularly into that shelter component that you mentioned.
So is service inflation is that what's going to be that makes or breaks this ability to get down to that 2% target and finally get inflation off the Fed's back?
I fully believe that. We've been seeing really good disinflation in the goods areas, but the services areas remain too hot. And if we think about concerns about wage price and spirals, that's really in the services area. And so from the sustainability of the inflation trend, getting that disinflation into services is key. And thinking about the FOMC minutes from the January meeting, there was a lot of focus on what the Fed was saying in terms of both level as well as trend. And I believe that they really focused on seeing an improving trend and that the sustainability of that trend.
With that said, Michelle, let's talk about what we've been seeing in earnings results so far. We were talking earlier about Goldman upgrading at least its year-end target on the S&P 500 on the back of positive profit outlook that we've seen from companies so far. How have you shifted up your portfolio as a result of what we've heard from companies at all, or have you at all?
So it's difficult for me to talk about moves that we're potentially planning, but at the same time, from a broader views perspective, what we're seeing currently is very favorable for equities versus fixed income. We'll be thinking about a robust economy, but the risk that the Fed may have to be delayed further into the year, that talks to an environment that's supportive to more cyclical areas versus areas that are sensitive to yields.
So how aggressive do you think the Fed is going to have to be if, by some estimates, we're potentially looking at a June rate cut or later?
I think June is potentially still on the table. Obviously, it fully depends on the trajectory of inflation and if we do see those encouraging trends. Additionally, with the June FOMC meeting, that's when we're going to get the updated projections as well as getting an updated dot plot. And so those are a lot of information that can really give investors a lot of insight into the expected trajectory for those rate cuts. There's going to be a lot of focus on any data point leading up to that. And so we could see some interest rate volatility coming into that period.
And speaking of other things that we're tracking in terms of volatility, obviously we're going to have Nvidia earnings coming out. For people who are seeing some of these market moving events that are coming up ahead, how are you advising clients to really, gauge the situation so that they're not tempted to panic sell or panic buy?
Yes, so definitely diversification is extremely important. If we think about the year that was last year, diversification didn't work great that year, but we believe that diversification is going to become even more important into this coming year. And that's an important element to ensure that investors don't panic buy or panic sell. We do think that market breadth needs to improve. We have had a very concentrated rally thus far this year. Obviously, everything's waiting on the Fed, and that has been a factor that's impacted on the concentrated nature of the rally. But we are likely to see that starting to broaden out as we go through this year. But also different areas of the market are really important as we're thinking about how to actually position for this current environment.
And just quickly, some of the other areas of the market that you think people should be paying attention to.
So with the more robust consumer activity, industrials is a key area that can stand up better as the economy remains strong. Conversely, we're becoming a lot more cautious on areas such as utilities that are more bond proxy-like, and do stand to detract from when the yields, if they do get pushed out longer and the economy remains robust for longer than expected.
I appreciate you joining us with your insights. Michelle Kluver there, thank you so much for joining us this morning.
Thank you very much.
All right, we've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. The US is seeing about 2.7 million more retirees than anticipated. That's according to Axios and a model designed by an economist at the St. Louis Fed. Now, to give you some context, that's 80% higher than the 1.5 million retirees 6 months ago and a new post-pandemic high. Economists are pointing to market performance and expectations for a rate cut as the reason for older generations exiting the labor force and taking those retirement gains with them. I thought it was interesting that in the article from Axios, they talked about data from Fidelity showing the number of retirement millionaires, those who became millionaires based on their 401ks, jumped 25% so far this year because of this rally. And I mean, retiring in a bull year, you know, it's certainly a good time to do it, but interesting that it's this many because of the rally, because of how much some of these 401ks have ballooned.
Yeah, not a bad way to go out, right? When you think about exiting the labor market, because it was just a few years ago, we were talking about those workers who were on track for retirement potentially having to extend or delay retirement because of what they were seeing in their retirement accounts. I mean, if you think about where the S&P 500 was last year, up more than 20%. The other thing that this data coming down, or this model coming down from the St. Louis Fed also points out, is housing prices. You know, they remain pretty elevated. So if you are of a retirement generation, or retirement age, I should say, that's another reason to feel comfortable. The other thing that, though, is something that we've been talking about, Rochelle, which is companies increasingly sort of pointing to the end, or at least the phasing out of remote work. And that if you have to go back into the office and you're close to retirement age, you know, maybe you don't want to make the commute. I mean, it's hard to pinpoint this on just one factor, but that is certainly a big bump when you think about where it was in previous years.
It's true. And you think of all the people who potentially now leaving the labor force when you already have a tight labor market. It'd be interesting to see how that dynamic plays out longer term. Well, a new study from the University of Arizona is debunking the commonly known retirement investment portfolios, saying there's one which reduces the risk of running out of money in retirement and sees major returns compared to the others. Let's bring in Scott Cederberg, University of Arizona Associate Professor of Finance and one of the researchers for this study, to discuss this more. So thank you for joining us this morning. So for people who weren't familiar with this study, I mean, this included a range of different portfolio strategies, including the popular 60-40, but there was a standout here in this study. What was that? And is that something that people can still apply going forward?
Interesting from our study, you know, the conventional wisdom is that you should diversify across stocks and bonds, and that, you know, maybe young people should invest more in stocks than older folks. What we find is actually 100% equity throughout into retirement and up through, I guess, passing away, does better than these balanced sort of age-based strategies. One key to that is, when I say 100% equity, you do need to diversify internationally. So like global diversification is very important. So our base case is thinking about 50% domestic stocks and 50% international stocks.
That's interesting, a 50-50 split there. When you say that those 100% equities, domestic and international, do much better than some of the most diversified portfolios we have become accustomed to feeling a little more comfortable in, to what extent did the performance differ? I mean, how much better did they perform?
Yeah, I think it's probably not surprising to people that during the working years, as they're accumulating assets, that an all equity strategy would give them more wealth at retirement on average. What we find is that it gives kind of an entire better distribution. So even the worst case scenarios tend to be better with the all equity strategy than with the balanced strategies. And then what's really interesting is, even through retirement, you know, we're using kind of a simple 4% rule for a withdrawal strategy, but it extends to other withdrawal strategies. But the all equity investors are actually less likely to run out of money during retirement than those that are trying to diversify into, you know, quote unquote safer bonds. So it really goes throughout the life cycle. They're safer even in retirement for retirees, as long as we're kind of thinking about eventual outcomes of retirees. I would say the one caveat is that if you think about drawdowns, so kind of what's if you get up to your peak and then kind of the biggest drop that you have during retirement, you're going to see larger drawdowns on average, kind of intermediate drawdowns with the all equity strategy. You just kind of have the strategy, like stocks tend to bounce back after crashes, and that's really what you're relying on if you're going to be an all equity strategy and try to capture the important gains that come along with that.
And Scott, in terms of the international exposure, I noticed that in one of the mixes you had here on a performance spectrum, those that were comprised solely of developed country government bills saw the lowest return. So for people who are trying to think of how to play the international market, but probably more used to the developed markets there, how should they be viewing it? What are some of the standout either countries or areas that they should be looking at to really make the most of their portfolio?
Yeah, so on the bills strategy, like that ends up being kind of terrible because bills are safe in nominal terms, like before inflation, but they really have a lot of risk if we're thinking about inflationary periods. And then we're studying internationally. Our sample is developed countries, but I think it could extend basically to a kind of a world global type of portfolio. So for U.S. investors, it's actually fairly close to just a market weight global portfolio. If we go 50% U.S. and 50% international, and then we would think about just weighting things internationally by their total value, kind of by their total market cap from each country.
And Scott, just to be clear, when you talk about an all equity retirement portfolio, what's the timeline we're looking at? You're not talking about people who are looking to retire in 10 years.
Yeah, our study suggests throughout your entire life that you would be all equity. So that's, going through to being 70, 80, 90 years old. You still get better outcomes compared with trying to diversify into the bonds. And I think part of this is, based on our data and our methods, bonds look riskier for long-term investors than I think was previously thought. And, we don't have to think very far back in the US, like 2021, 2022, if you held 10-year treasury bonds, I mean, that's a super safe asset in some sense, but you lost 30% over a 2-year period, and it's going to be very tough to get that back. So when bonds crash, they tend to not come back. And when stocks crash, there is a tendency that they typically do kind of bounce back. And so that if you can ride out the kind of bad times, you end up better off, even through retirement being an all equity strategy.
So Scott, when things are uncertain here, especially if we do start seeing a sell-off potentially depending on what happens with Nvidia's earnings, etc., should people continue to stay with that equity portfolio, given that longer trajectory still would have them back on track there? Or should they perhaps revert to something less risky, that perhaps less returns, but at least a little less losses as well?
Yeah, that's in some sense like the fallacy of what's tempting is to kind of pull back when stocks start, being choppy and going down. But really the key is to stick with stocks. Like that's the only way to get these kind of long-term safe returns is if you do ride out the really bad times. Because if you shift, if stocks go down and then you shift into something else, you're going to tend to miss the rebound. This would have happened in the financial crisis. This would have happened during the COVID period. But our overall sample, we have over 2,500 years, like country years worth of data from developed countries. And this is just the tendency that we see kind of throughout history and across countries, is that stocks tend to bounce back and bonds tend not to.
Some good takeaways there. Scott Cedarberg, University of Arizona Associate Professor of Finance. Appreciate the time today.
Thank you.
Well, we are watching Nvidia shares pushing lower here, down nearly 6% ahead of its much anticipated earnings report after the bell tomorrow. Here's a look back at how the company got here.
From creating graphics cards for gaming to becoming one of the world's leading AI chip companies, it's safe to say Nvidia is officially one of the tech giants. In 2023, the company generated nearly $27 billion in revenue, and its market value is well over $1 trillion. Let's take a closer look at what led to Nvidia's boom with Beyond the Ticker, where we dive into the company's biggest moments. Nvidia was founded on April 5th, 1993 by Jensen Huang, Chris Malachowski, and Curtis Priam, with a vision to bring 3D graphics to the gaming industry. In 1997, Nvidia launched its first hit product, the NV3. It would later go on to sell a whopping 1 million units in its first 4 months of availability. On January 22, 1999, Nvidia went public via IPO at $12 per share. And in 2000, Microsoft chose Nvidia to develop the graphics hardware for the first Xbox console. 5 years later, Microsoft's rival Sony chose Nvidia's hardware to power the PlayStation 3. In 2010, Nvidia became the graphics chip supplier for automaker Audi. And in 2015, the company launched its Nvidia Drive chip for powering driver assistance technologies. In 2016, Nvidia kicked off its AI efforts with the launch of the DGX-1. 2 years later, later, the company debuted Nvidia RTX, the first GPU capable of real-time ray tracing. That same year, Google announced it was using Nvidia's Tesla P4 graphics cards for its Google Cloud platform. In 2022, Nvidia debuted its H100 graphics chip for AI, which still stands as one of the world's most powerful chips for artificial intelligence apps. And in May 2023, Nvidia eclipsed the $1 trillion market cap mark, joining the ranks of mega companies like Apple and Microsoft. The stock continues to surpass its all-time highs over the past month and is currently trading at over $700 per share. From a company of 3 engineers working on graphics cards to thousands of employees working on chips that will power the AI supercomputers of the future, Nvidia remains at the top of the tech industry.
Wall Street eagerly looking ahead to Nvidia's fourth quarter results. Here with what investors could keep an eye on is Yahoo Finance's Dan Howley. Now, Dan, this is the one to watch, the most magnificent of the Magnificent Seven.
That's right, Michelle. This is going to be probably a big make or break moment for the AI trade. Investors are, at least Wall Street analysts, are anticipating a massive jump year over year as far as Nvidia's revenue goes. We're talking about $20.4 billion in anticipated revenue, up from the $6.1 billion the company reported in the prior year. And just to put that number in perspective, in 2022, Nvidia reported full year revenue of $27 billion. And now Q4 of 2023, they're expecting to be $20.4 billion. So nearly all of its revenue for 1 year coming from one quarter. It's a staggering look at how much the AI trade and AI sales are powering this company. Now, there's a few things that I just want to go over quickly when it comes to Nvidia and the chat. And, I mean, part of it is going to do with its guidance. We have the revenue, the AI data center side of things going to be clearly incredibly important. It's anticipated to be around $17 billion. That would be a massive increase from the $3.6 billion last year for the data center revenue. But then guidance is also going to play a big role here. We've seen Nvidia beat time and time again in recent quarters when it comes to analyst expectations for forward guidance. And if they're able to do that again here, you could expect the stock to just explode as we've seen in prior quarters. If it's a little more muted, maybe not so much. But we've seen some analysts come out with new price targets, jumping as much as $200 for shares of Nvidia. So they're obviously looking for some kind of big increase here. And then another thing that we're going to hopefully hear are comments on China. Obviously, there's the trade restrictions that the U.S. has put in place on certain technologies to China, including some of Nvidia's biggest, most important chips, that H100 chip. They're working on workarounds and have worked on workarounds. They have said that it's not going to impact their revenue at the current rate, but they've said that going forward, they could miss out on a large chunk of potential revenue if they're not able to get into the Chinese market or can't get their biggest chips into the Chinese market and see other competitors, Chinese competitors in particular, jump in there and take their place. So those are three of the things that we're going to be looking at, but not to be left out. This was once a primarily gaming-focused company. Gaming revenue is expected to come in higher than last year. We're looking at about $2.7 billion in the quarter, anticipated, up from $1.8 billion last year. So gaming's still an important part of this, but obviously data center is where it's at right now.
Indeed, no surprise, Nvidia, our top trending ticker on Yahoo Finance right now, and SMCI, Supermicro Computer, not far behind, another beneficiary there of the generative AI rally. Appreciate you, as always, our very own Dan Howley. All right, well, let's get you a final check of the markets as we head into the noon hour. Looking at red across the board here, although relatively flat, at least for the Dow here, currently down about 76 points. Looking at the S&P 500 there, down about 0.7% or about 36 points. And of course, the tech-heavy Nasdaq taking the biggest hit of the day so far, although off some of its session lows, but still down about 215 points as we await what we'll hear from Nvidia tomorrow, of course. And really sort of having this shorter trading week, so sort of a collective breath here for investors at the moment. Well, that does it for now. I'm Rochelle Akufa alongside Akiko Fujita. Stay with us on Yahoo Finance.